holding a stock for 40 years, 30 years is very hard. The only person who successfully done it that I know is Warren Buffett and my grandfather. Okay? The rest that hold stocks for 30 years is not because they were making a decision to hold it, they forgot about it.
Yeah, yes, true.
Right?
True. So true.
I have to tell you this story. I don't know if you know, there was a study. I think you know this story. There's a study in the US, Fidelity.
Yeah.
They actually looked through all their brokerage accounts and they were calculating the returns and they were trying to find a commonality as to why people were having high returns.
Yeah.
Do you know what was the number one factor for the accounts that had the highest returns?
Yeah, all right.
They died.
Yeah, that's the point, right?
Don't touch it, right?
Don't touch it.
Don't
Exactly.
touch it. Coffee can investing, just put it in, pop, and then that's it.
Exactly.
Yeah,
It's
crazy.
So that's
Before we begin the podcast, have you gotten your free ebook? It's called the Build a Six-Figure Portfolio Guidebook. Now, inside it, we share with you the tips and tricks to bring your stock investing skills to the next level. The best part, it's only 10 pages long and it's totally free. Whether you're on Spotify or YouTube, the link to download is in the description, or you can go to www.firl.co/FREE or www.firl.co/free. Welcome everybody back to the podcast, best place for long-term investors. Today is quite historic because we will be interviewing the guys who found or who was part of the first ever Malaysian hedge fund.
Beautiful. And the first time we're having two guests simultaneously.
In this space, yes.
Exactly.
In our own space, we had to. So anyway, welcome to the pod, Devan and Donovan.
Donovan, whatever you want to call me.
Yeah.
Devan, yeah.
Yeah. Thank you so much for spending time with us, guys.
No, thanks
No
for
worries,
inviting us.
yep.
Yeah.
So anyway, before I begin, how are you guys doing so far?
I think great because market went up, right? Since 2 weeks ago. So if this is an investment podcast, the answer should be great.
But before we get into investing, I want to learn a bit about your history, both of you, as to how you got involved in investing. What was money like to you when maybe you were in school, right? So maybe we'll start with Devan.
Well, money is a tough question to ask because when you go to our website and you look at our history, you think I have a lot of money, but
You should be swimming in it, right?
no, but that's not
More than me for sure.
that's not necessarily the case.
Yeah.
So, I mean, when I was young, I just started out as like any middle class family. We didn't have any BMWs in the house. It was just a Proton.
Okay.
It was just a Honda.
Oh.
I took a school bus to school.
Just like
You know,
everyone else.
even in secondary.
Okay.
Yeah, so it wasn't like you would think a hedge fund, you start from riches and then you just continue it.
Yeah.
Even if you read the company's website history, because ultimately the background of my family and myself, it's just regular folk. Just like I think your website, your company's name is what? FIRL.
Finance in real life.
Yeah, so real life, right?
Yeah,
Real
yeah.
life is just normal people who had a day job. So my grandfather was a school teacher, became a headmaster. My mom was a stockbroker. One of my uncles is a doctor. My other uncle is also a stockbroker. My aunt is my aunt is a doctor. Then my dad is in management as a GM. So just some of us are employees. Technically, you could say my mom, when she sold the firm, she became an employee. So we're just regular household, and everybody, I guess, have a different contention in life. For me, when I grew up much later, then I said I want to make more money because I don't want to just drive a Proton. I want to drive maybe a BMW, right?
Yeah.
So I'm a bit more money minded. But when I was young, I was just like anybody else.
Was money or investing or even equities just discussed at the dinner table? What is it like as a 15-year-old sitting at the dinner table? Was it openly discussed, or was it like a taboo subject or hush-hush?
Yes and not yes and no, because actually when we were very young, it was not discussed at all. We were just like any household. We're not an equity family. And I think if you talk to other people whose parents are bankers or even parents are necessarily lawyers. It doesn't mean that the dinner table is about law or the dinner table is about banking. It's just, this is your father, this is your mother. He just say get good grades. Don't be naughty. Things like that. It's not about investing. But of course, sometimes if you're curious, then you ask, hey, Dad, what do you do? Mom, what do you do? Why you always go to work at 9 and then you come home at 6, right? Why can't you come home at 4 like the other parents? Then you realize, because the stock market closes at 5:30.
I see.
I can't remember what time it closed, but I remember my mom used to come back late compared to maybe some other parents' moms.
I see.
So then later, what do you do? You're a stockbroker. Grandfather's a stockbroker. What do you actually do? Then you find out, you buy stocks, you invest, the stock market goes up. So only much later, and it was more that I was curious that I asked about it. So when I was a kid, around probably, I think it was, I can't remember whether it was Standard something or Form something. My first stock that I bought was Popular Bookstore.
Oh, are they still listed?
At that time, they was because so I said, hey, you're a stockbroker. What do you do? You make money. So a money thing.
Okay.
So I was like, you can make money. So then I was like, what should you invest? So then that's where probably kind of started, you can invest in these things. Here's the list of the stock market. What do you want to invest? And I said, based on my opinion, since I'm a kid, I'm buying all these textbooks, right? Everybody seems to be going to a Popular Bookstore. So then that is the first stock that I bought.
Great.
Yeah.
Don, what about you? What's a 15-year-old?
Mine was very different. My dad was in the Navy. So obviously I knew what he was doing, right?
The
Compared
Malaysian
to
Navy.
Royal Malaysian Navy.
So,
so
Lumut.
cool.
Sepangat.
Yes.
Lumut.
Yeah. So
I
my
was
dad,
just talking about Lumut to Jonathan yesterday.
why? Because he's from Lu?
No, because I was telling him the antennas that you will see coming into Lumut. You know all the antenna arrays? Yeah.
I mean, I used to go there quite a fair bit as a kid.
Yeah.
But my mum refused to stay in Lumut, so we used to go to Pangkor Laut.
I see.
When it was Pan Pacific before it became
The-
YTL Resorts.
Yes.
It was
yes.
Pan Pacific back then.
There's a lot of peacocks, right? I don't know if you remember.
Yes,
That
I think
resort,
so.
right?
Yeah.
Yeah.
It's been a while. So I mean, for me, it was a bit more clear cut, right?
I
so
see.
obviously, my dad being in the Navy, my mom was in corporate.
Okay.
And my first foray into, I guess, stock market, equities, whatever you want to call it back then, was every morning my mom used to wake up in the morning and rush down, check the Star newspaper, look at the business side. And
This
look
was
at
the 80s, I'm guessing.
90s.
90s,
Early
yep,
90s, right?
Okay.
And friends calling the house phone, saying buy this, buy that. And I guess they were fully operating on rumors back then. So my mom would always do that.
Okay.
And so every morning before getting ready to school, that would always be playing in my ear.
I see.
Right? So for me, it was just that was the natural, I guess, way into the markets. Just hearing my mom talk about it and going, okay, that's how she's, I guess, making a buck or two outside her corporate job.
I see. I see.
But it was never a conversation of the stock market during dinners. Never.
Never.
Right,
Okay.
You know, my family dinners to this very day is 10 minutes long.
Okay.
It's about how quick we can eat dinner and then and then bugger off and do our own thing. So
Okay.
that's always been the case with us.
Then how did both of you all meet? Did you meet in school or at work?
So
or before that?
So I mean, fortunate or unfortunate depends on how you're. Devan will say it's fortunate.
Okay.
Sometimes I say it's fortunate.
Okay.
But we bumped into each other in a company called Accenture. We were working. We were both management consultants in Melbourne. So prior to starting MTC, I never worked in Malaysia. I mean, I grew up and then I went after school. I went to university.
Your dad didn't push you into RMC or something, right?
I was a disappointment because I didn't go to RMC, right? Because they all went to RMC. My uncles all went to RMC as well. And my grandfather was a policeman.
Oh.
So a lot of military sort of thing.
Yeah.
Me going into finance was the complete thing for him.
Black sheep of the family.
Black sheep of the family.
Yeah.
But yeah, we met in Accenture, 2010. We met.
Yeah.
Christmas party. Not many Malaysians work
I see.
for Accenture in Melbourne.
In Melbourne, yeah.
Right? Handful. Right? So I think Devan and I the fact that we were Malaysians working there, just naturally gravitated to each other.
I see.
And then I think I think he didn't have enough friends or something. He wanted to be my friend. So he wanted to be on the same. As a consultant, you're on projects, right?
Yes,
so you're constantly
yes,
on
yes.
projects and all. I think he tried to get onto one of the projects that I was on.
Now I know why you say he keeps saying he's fortunate. Right? Right. But I mean, in terms of for both of you, the passion for investing, right? Like, did it begin before or after work?
At that time or before?
Like the essential days?
just in the
Before the essential days or
Yes,
after?
before or after the
way
essential?
before.
Oh,
Right.
Way before for me.
So what was that like?
I mean, for me, it was also interesting because my sister also graduated in Australia, and her
Okay.
first job was actually at Goldman Sachs.
Oh,
So she was the one that was constantly talking about
equities.
investments.
Right.
I see.
Well, not just equities, just investments in
So
general.
come on, everything every asset class that is investable.
Correct, right?
Yeah.
And that to me, studying finance. Well, I studied accounting economics, but naturally in Australia, that's at that point in time, and we were that 2006, 2007 when
Yeah.
things were hot in Australia.
Yeah, yeah.
Right? The mining boom was hitting Australia. You were hearing so much, stories of people being multimillionaires overnight, buying, penny stock A,
Yeah.
mining stock company one.
Yeah.
And then that was always in the back of my mind. And eventually my first paycheck, I remember buying my first stock as well.
Which was?
How do you go?
Actually, no, it's still doing quite well.
Wow.
I don't have a lot of it. I should have bought more of it.
Yeah.
But this company called Coles.
Okay.
Well, West Farmers back then.
Yes, West Farmers. Yes, yes.
West Farmers. Yeah, that was my first ever stock purchase. West
Right.
Farmers.
Wow.
That did not make me a lot of money.
Okay.
Right? But it was good. It's still
Yeah.
good now. I
Yeah.
started dabbling into a lot of mining stocks, which
I
is
see.
that I wrote off, right? Basically after 8 months, wrote off. But yeah,
Right.
that's how I got into it.
Okay.
How about Devan? Yeah.
Yeah. How about Devan?
Well, for me, actually, after Popular Bookstore, I stopped investing after that.
Oh, really?
I sold it off, got double my return, sold it off. And this, I can't remember whether it was the 90s or I think it was the 90s, late
Okay.
90s, right? So at that time in Malaysia was a sort of a trading, lot of tips boom.
Correct,
So even though my mom is a stockbroker and also an investor, so normally it's long term, but then occasionally even the best of the value investors sometimes get,
That's right.
not to say suckered in, I don't know what nicer word to use,
Yeah.
but they get tempted to also trade,
Understood.
right? Because it's more exciting. We can make 100% in a week,
Yeah.
right?
That's right.
So I don't think, I can't remember whether I made it in a week or a month or two, but I remember doubling the money and I sold it off, right?
I see.
And that's it. Then after that, and I think it was around maybe, I can't remember exactly, but maybe it was probably during the year-end holidays of school, so it's probably November to December. So after that, I went back to school, forgot about it. So never touched investing anymore.
Wow.
Until I went to university, and I had no intention to actually enter the investment world or banking, or because I saw my mother, she works very hard. Every day in the morning, she would wake up really early, and then she would read the newspaper while sitting in the car. And she cannot read in the car because she will get a headache.
dizzy, yeah.
Dizzy is the right word. But yet she still will do
Because
so.
that's the time that she can,
Before she goes to office.
Yeah.
And then she comes home late compared to what I hear my other friends' moms come home.
Yeah.
She comes home just in time for dinner. Then she has to sleep and then wake up early in the morning again to go to office again and then read the newspapers. And then on weekends, she's reading newspaper again.
I see.
On Saturday and Sunday.
Okay.
And also reading some other stuff like long time
Journals.
ago, journals, books and whatnot.
Okay.
I think a long time ago, they don't exist anymore. They used to have these books that would summarize stocks.
Something
So-
like Barron's or something like... what
Not
was
a
it?
magazine.
Moody's manuals.
Moody's
and all that, is
manuals?
it?
You could say equivalent
Yeah,
to
yeah,
something like that,
yeah,
right?
yeah.
And I think Malaysia has this one book that every year release that they summarize Malaysian stocks also. Okay, so she would read things like that on the Saturday, Sunday. So I look at that, hey, I don't want to work on the weekends.
That's not a life that you envy, like. in a
No,
way.
no. So I never was necessarily interested in finance per se. So somehow someone told me you should study law, and then I ended up studying law and accounting. And it was only and then I realized I was not going to be a very good lawyer. So then only my third year, I decided to focus on finance.
I see.
Right.
And then I added that as my elective.
I
So
see.
then I got my first subject in, I think, I can't remember what the subject was, something to do with capital pricing model, but basically more investment related stuff, not accounting, because accounting is not investing.
Yeah.
It's completely different.
Correct.
So a lot of people, or general business subject is not investing either. It's completely different. Neither is economics. Economics is not investing.
Correct.
So then I had a first finance subject for the first time, because if you're doing a commerce and law degree, all the stuff on the commerce side is all 100, 101
Oh, it's
courses.
the
Very
basics.
basic.
Basics, yes,
so you don't
yes.
touch anything with investing per se.
Yeah.
So when I thought, I was like, oh, this is kind of interesting, right?
see.
Investing. Then it seems like, oh, you can make money. I always liked money, right? And the reason I took law is because someone told me as a lawyer you can make a lot of money.
Can.
Yeah.
Yeah, but long hours also lah.
They didn't tell me that. The TV shows didn't tell me that either. So then I was like, hey, my mom's a stockbroker. How come I'm not asking her? So I picked up the phone and I called her from Australia. And I said, tell me more about of the stock market.
Okay.
And so we will constantly call every week, and maybe even more. I'm not sure. And I'll be constantly asking her a lot of questions.
Okay.
And then I read a book about Warren Buffett at that same time. I think it was my third year in uni. And that clicked straight away, his philosophy of value investing.
I see.
And then I asked my mom what my grandfather, because my grandfather was the first chairman of the Malaysia and Singapore Stock Exchange. So he was quite known as an investor at that time. So we don't talk about what stocks to buy, but occasionally we do on the dinner table. At least my mom talks and my aunts and uncles talk about my grandfather, their father, because they
see.
were quite enamored by him. So then I said, yeah, you always talking about Kong Kong, they call him Kong Kong, and how he's investing in this, blah, blah, blah. So I said, tell me more about how he picked stock. So I asked more direct, because my uncle, my parents, they'll never talk about investing. So they're not trying to in the household teach you about investing.
Oh, why
It's
is
only
that? Why do you think that that's so? Was it because they felt that you were
because
not
all of them
ready?
got into the industry by accident.
Oh.
It's not. My grandfather I told you, was a headmaster.
Yeah.
Correct.
Yeah, it was by accident. It was not that he wanted to be the best investor in the world. It's just he
see.
was so good at what he did.
I see.
The only reason he went into investing is because he was a school teacher and it was not enough to send everybody overseas. Not that he sent
Right.
all my uncles and aunts overseas, but his intention was to make enough money so he could afford to spend on all his children for education.
But somehow or other, he managed to
Yeah.
find
How
excellence
did it
and
happen?
to become a
Because
chairman.
actually, if you think it very logical, not to say it is also hard, but it also can be very easy investing. The main area of investing where it becomes a challenge is actually not necessarily the lack of. You don't need a high IQ. What you need is a lot of discipline, and what you need is very high character. And I don't know what the term is to describe. You must not panic and things like that.
Controlling your emotions.
Controlling emotions more so than how smart you are. You know, so it is a skill that he had as a school teacher, and he was a very
see.
disciplined person,
see.
and it was very logical. It's not about being the smartest. There's no rocket science in the investment
right.
world. It is actually quite simple. If you look at this company, you look at that company, not talking about speculation, you can say this company is cheaper than that. It's very simple because the numbers are there, right?
Yeah.
If one company is paying you a dividend of 10% and the other company is 2%, which is better, the 10% dividend company.
Correct.
So it's very obvious. Now, if you think both these stocks are equivalent, they're not going to go bankrupt, they can pay their dividend for the next 20 years, then why wouldn't you get the 10? So it's actually very simple. It's the problem comes when you buy the 10 and then the stock market changes every day and then you're like, oh, maybe I'm wrong. Then your friend tells you it's wrong.
Yeah.
Or not necessarily your friend, maybe your business peer in the industry who you
Right.
look up to, who you think is very smart, tells you you're wrong. So you think, oh, if this guy says it's a sell, I must sell also.
Because he's like an insider, right? He knows all
But
these
maybe he doesn't know anything. That's what you
Yeah.
realize, right? So, so actually, that is probably the reason they don't talk about it in the
I
household,
see.
like as a thing, because they're not investment first. Maybe me, I would talk in a household
Yeah.
with kids. but not my uncle, my aunts, or my parents.
Did you manage to grow up with your grandfather? I mean, did he pass on very early when you were young, or did you manage?
Not direct, so it was through my mom.
I see.
And my uncle. It's not direct.
So it's in a way, knowledge or experience passed on through his kids, his children, your grandfather's children.
Yeah.
That's
So it was
interesting.
through asking him. I think I am quite a curious person. So
Okay.
I ask him questions.
Okay.
So I'll ask my mom question. I'll ask even my aunt who is not in the stockbroking field questions. My uncle questions. I'll try. That time my aunt who's what do you do? Oh, then he'll say, oh, my grandfather used to take out these charts and make me write this chart, chart this thing, and then I had to track it for him.
Okay.
So I asked so many people questions. That's how I learned, right?
I see.
So that's how I got into the. Well, but that was much later. The first thing was just me asking my mom all the questions. And then I realized, hey, actually my grandfather has done the exact same thing that Warren Buffett done in his stocks in US, but for Malaysia.
I see.
So I said, oh shit, my grandfather also is a very good value investor. The only difference is he grew up in Malaysia. So globally, he's not recognized.
I see.
Right? Or even locally, he's not recognized because he was not a marketer. Okay? He was just making money for himself and his family.
Understood.
It's just by accident he became a stockbroker also.
Okay.
Accident also.
Yeah.
Not on pursuit.
Okay.
I think he only became a stock broker past the age of 50 years old.
I see.
Because
I
he was
see.
famous for getting a very high return.
As
As a client of the
client.
stockbroking firm.
wow.
Not because he was in the industry.
Yeah, because you see, right, most people, I mean, from what, don't talk about the US or whatever, in
Yeah.
Malaysia, right, most of the people I see that are in the exchange or in the Securities Commission, which is like the regulators and the,
Yeah.
they don't end up like in the US where you've got a guy from Goldman Sachs in SEC.
No, you don't know.
You don't get that in Malaysia, you know. So that's why I was trying to link how on earth did a teacher, right, and then a value investor, and then suddenly of an exchange, chairman of an exchange. How did that dots actually connect? You know, I don't know.
Because at that time the KL was very small. I'm talking 70s here, 60s here.
Okay.
KL is very small. So whoever in KL you know, if it's the like for example, my mom talks about her friend who was the first chartered accountant in the country.
Okay.
Oh.
I mean that's like at the 60s because there
60s.
didn't exist chartered accountants at that time.
Yeah,
You
yeah.
have to go to UK to
Wow,
get it.
okay.
Yeah.
So but of course he's much older than my mom. He's passed away already.
Okay.
So at that time you had a lot of the first of everything.
Correct.
At that time when my mom was working in the firm and my grandfather, that time you would the stock exchange was a chalkboard,
Oh yeah.
Yep.
right?
Yes,
It was a chalkboard and then there was scripts. It was not electronic trading, and you can lose the script means you lost your money.
Wow.
Okay, and you see money is like 100 ringgit, 10 ringgit, 5 ringgit, 1 ringgit. That time I don't know whether got 100 ringgit or so.
I think there were.
But even the worst is worth a lot.
Yeah, it's worth
Right?
a lot of money
Because
back then.
food
Inflation.
in the food court, like a ice kacang or what, it's like 1 ringgit you can buy, 50 cent you can buy.
Yeah.
Right?
Yeah.
So a stock script could be worth a lot,
Yeah.
especially if you're keeping many. You know, so then you have to keep them in the safe and stuff like that.
Right.
So very different time. So I guess as an investor, these people knew him and then say, why do you come and join?
I see. I
Right?
see. Eh.
Why do you come and the main thing actually of how he entered the industry was because he was a headmaster and he wanted of Methodist Boys School.
I see. MBS. Yeah.
Yeah, and sorry, he wasn't a headmaster of Methodist Boys School. Sorry,
He was
a
alumni.
science teacher of a Methodist Boys School, intending to be the headmaster of Methodist Boys School.
I
He became the
see.
deputy of headmaster of Methodist Boys School. So because they gave someone else who was more senior than him.
I see.
So in consolation, they gave him headmaster of the second Methodist school.
I see.
Okay.
So not Methodist Boys School. I think it was Methodist College or something. Can't
Okay,
remember.
okay.
But the second school, there were two schools. So for him, it's like, if you think about all of us, if we are talking in terms of finance, someone says, I want to be the chairman of Bursa, right? That's the end goal. Or I want to be finance minister. You may not, or I want to be Maybank CEO. Maybe even if you become, nothing wrong with it. Even if you become Affin Bank CEO, nothing wrong. But maybe some people want to be Maybank CEO, largest bank in the country. So to him, by not being the number one headmaster for that school, he got the second school. He said, "I will resign after a year or two. I want to be the best."
I see.
And then at that, so he said he's not contended to be second best. And so that's, at that time he was figuring out what to do. Someone said, since you're such a good investor, why don't you join the stockbroking firm of Malayan traders at that time? And so he joined the stockbroking firm brokers. Brokers are different from investors. They're completely different things. And he ended up controlling the firm. He bought out more of the shares of all the other partners at that time. And then he became the chairman of the stock exchange. But actually, he's not a broker. He's an investor first.
Understood.
That's such a cool story. I have to ask, right? Are there any other stories about your grandfather that is like?
There's a lot of old stories, but I think the stories about me and Don.
That was a lot. I mean, that's how I naturally gravitated to Devan as well, right?
Yeah.
When we first started talking about it, and you hear stories like this.
Yes.
So you go, wow, that's freaking cool, right? Shit, this is the guy that's the first chairman of the stock exchange, right?
Yes.
You don't hear that, right?
Yeah, exactly.
Yeah.
And so for me, it was also, I mean, how much knowledge have you, I guess, acquired from your grandfather or your mother and all of that, right? Because you come from almost, he might not see it that way,
Yes.
but someone who's outside the family,
Correct.
I look at it and go, wow,
Wow.
what a privilege to be able to.
It's
get,
almost like a illustrious family, you know.
yeah,
coming
yeah,
together.
exactly, right? Like how do I
Royalty.
But that's what
Correct.
they think, but it's not the case.
Yeah.
As I said, I
It
took
feels
a
like
bus
it from
to
the
school.
outside, right?
from the outside, right? And again, this is like in Australia, and we started talking and all of that, and then you start realizing, actually, even as much as we talk about how it's investment royalty in Malaysia,
Yeah.
a lot of the stuff that he was doing, Devan doing, whatever the grandfather doing, what I was doing, it's the same thing.
Yes.
Yeah.
It's the same thing,
Yeah.
right? Just because someone else did it doesn't make what we do on the side any different.
That's
Correct.
right.
Right? And that's how we connected,
I see.
right? Because I
see.
realized I was doing the same thing, he's doing the same thing, and that's what you can get. Wow, right?
Yeah.
I mean, everybody is investing actually.
Yeah.
From the shopkeeper that sells goreng pisang, he's also investing. He's buying Maybank shares, right? It's good and hope he sticks to Maybank shares and don't buy all the speculation, right?
Yeah.
But everybody is putting their money somewhere, whether it's Amanah Saham, whether it's EPF, that's investing. And I always tell people that actually cash also is investing.
Yeah.
A lot of people think, I don't want to invest, so I hold cash. But actually, cash is a decision that you're made to hold ringgit.
Yes.
If you're holding cash in USD, is a decision you're making to invest in America.
Yes.
If you're holding Russia, ruble, there is your decision to invest in Russia. Now, if Russia go into war, then your Russian ruble is worth nothing. Same with Malaysia. If Malaysia economy is not growing, or political issues, etc., your ringgit is dropping, which is the case. So when people say, I don't want to invest, I hold cash, that's also a decision-making
100%.
process.
Yeah.
But people don't see it that way, so then they just hold cash, which they think is safe. But it's not necessarily safe because you are always competing with inflation ultimately.
Yeah.
That's the thing you have to always compete with. That never stops. So everybody should be thinking about investing to a certain degree. But also at the same time, because it's also very challenging, it's not so much the IQ, it is the discipline. And if you don't have the discipline for that, then you should do the more safer way of investing. Yeah.
So I have to ask now, speaking of investing, that I want to get a sense of what is the style that you guys would ascribe to, because the word value investing, if you just Google it, it's like so many different, right? So many different styles. And I just want to allude to this because one thing that struck me that is very interesting that I rarely see in other firms is on your commentaries is your distinction between fair, deep, and value. When you guys break down in the nice pie chart, right, to say this is our allocation right now. So give us a color of really what is the MTC style?
So to talk about value investing, actually value investing is actually very simple and basic. The original term of it,
correct.
which is what started with Warren Buffett and Benjamin Graham, which is actually, even if you read their literature, it's also the way it's written or the way they prescribe it or talk. They say it's a simple thing that anybody can do. And if you have a podcast that's on YouTube, there's a lot of YouTube videos on them.
100%.
And you listen to their YouTube videos, and then you hear them saying, actually you should not give your money to a professional manager. You should just do it yourself because it's so simple. You will hear that a lot of times.
Yeah.
Because the whole concept of value investing is this one phrase: basically buying a company that a good company at a reasonable price. So if you take a notch further to be, then you're buying a great company at a discounted price or a cheap price, then you make a better return. But the original concept is buying a good company at a reasonable price. So that's the crux of value investing. Over time, because of Warren Buffett, mainly him, and he's a legend and a public legend, everybody decided, how do I sell my fund or my strategy? So everybody takes the label value investing and put it on their asset management company or their course or whatever, and they plug value investing there because it's an easy sell because you say teaching you how to be Warren Buffett. But the concept, but if you analyze all of them, not everybody follows that because
No.
they put value investing, then you say, hey, why is he buying Asia? Because that is not value investing.
Right.
Doesn't mean you can't make money in Asia. So like we are saying here, maybe you can. But that is not value investing. So if you buy Asia today or anytime during COVID, that is not value investing. But some people say value investing, Asia share price went from 3 years ago, $3 to
discount,
60 cents. Discount, value investing. That is not value investing. Value investing is buying a good company at a reasonable price. What is considered good? Okay, now you can argue Asia is good, right? Fly, everybody use. But good is also not just the business, it's the business plus the numbers.
Yes.
Means it's a profitable enterprise that can be sustainably profitable, plus the business the business subjectivity of it, of how it operates to back that up, to say it's sustainable. Rather than once off, or long-term not sustainable.
Correct.
And not highly indebted, has cash on the balance sheet, not owing people money, these are there are many things you can do to describe what is good, but that's good, right? So you could say maybe Asia is a good brand, but then maybe on their finances you say bad because it's true, it's bad. You cannot lie. I'm sure if you ask Tony, he won't lie to say it's bad finances, but you say it's good on the prospect, right?
Yes.
So, but if you're going to say that's value investing, that's wrong.
Right, understand.
That could be turnaround. That's more turnaround, I would say. So that is the main concept that we practice, which is that concept. Then when we say deep value, fair value, you mentioned earlier. So what we were just saying, deep value means it's either a good company that's extremely cheap or it's a great company but reasonably priced.
I see.
So it's a relative, right? Because ultimately when you invest, you're comparing everything. So sometimes we also have not performed as well as we could have performed because we have thought of this concept called diversification. But not everything is equal.
Correct.
Something is better than the next. Right? So for example, for us, our first few stocks was Apple, Nike, Google. Now, if you track from that time till today, Apple was the best, right? But if you did 50% weighted to Apple, 25, you would done better than if you done equal weighted.
That's right.
Or maybe at that time you thought, and I will tell you at that time, you can ask him also. A lot of people and the peers around our age will say, Apple's lousy lah. At 2010.
2011.
What was the trailing PE back then?
The trailing PE was 10, but everybody looked at it. Yes. You go dig
This
it
was
out.
2012, right?
2010.
2011.
2012 also 10.
Because that was, I believe, the period where a lot of the alternative smartphones were coming
Yeah.
out.
Samsung was coming up. Samsung was coming up.
We were valuing Apple not on the iPhone. We were valuing purely on the iPod. That's it.
Really?
And the MacBooks.
Wow.
Because the iPhone
2007
first came out in around, I think 2007 and 8. But it wasn't, the BlackBerry was the dominant thing.
That's right.
Right? So, but we are valuing, so if you're valuing it based on iPhone, then that's already speculation. That's not value investing.
At that point in time.
Because that's prospective earnings. That hasn't come yet. And iPad didn't come out until 2009. And I know this because I invested in Apple in 2007.
I see.
And you can Wikipedia it. iPad is 2009.
And the 3G just came out.
The 3G was a big thing for them.
2008 and 2008, early 2009.
I see.
But we were investing it based on iPod and MacBook. At that time, it was in 2003 and 2004 was the Windows versus Mac. And then they had the ads. You got all these cameras here. I don't know how to use Macs.
No. We
A lot of these camera
use an iPhone.
people who use
yeah.
this and that like Macs.
Yeah.
I see.
Creatives.
That's
Okay?
right. That's right. That's true.
Now the finance people all use PC. So
Correct.
you can imagine the finance people don't know what a Mac is.
Yes.
So they can say Mac?
Yeah.
They went bankrupt before.
Yeah.
So it was not a hot stock.
I see.
It was not a hot stock. And then 1999 tech bubble burst just
Correct.
happened.
Yes.
Correct.
So nobody wanted to touch tech stocks for like 10 years. So even Microsoft was cheap. Apple was cheap. Google was not cheap because it was a darling company.
Microsoft was very cheap.
Microsoft was cheap. Google was not cheap. Amazon was not cheap.
Because of Steve Ballmer. Sorry.
I will defend Steve Ballmer if you ask me the question later.
We will ask you about Microsoft.
We
That's-
asked
that's
about
good.
Microsoft.
Yeah,
So
yeah.
I think-
I'll defend him later, and then you can understand the logic of value investing.
Yeah.
But yeah, so that is value investing, right? Buying a reasonable company is cheap. And like I said, we're looking at trailing. You asked trailing, right? So
Yeah.
past has nothing to do with iPhone.
Right.
It's iPhone and Mac. So you're valuing based on that. So if that's P10 or 15, let's say it was 15, right? Now hardcore value investors, back at Warren Buffett's time and maybe even my grandfather's time, was all P10 was the benchmark standard, right?
Yep.
That was the gold standard.
You wanna
if
yield
come to live
out-
these days,
today you
right?
cannot buy anything 10.
You wouldn't be able to buy anything.
Yeah, yeah.
You think about it, right?
But at that time,
Everything's changed.
Yeah, exactly.
yeah, so that was the standard, right? If anything above 10, that's too expensive.
Yep.
Yeah.
So you really need to question that. But we can get into more on that later. But basically, on a nutshell, 10, right? Because if I am, what does 10 mean? If you turn it upside down, 10 means you get a 10% earnings yield.
Yes, right.
You inverse it. So if your FD at the time, Malaysia FD around 4, I think.
Yeah, correct.
2010, yes, about
When
4.
we studied in Australia, FD was what, 8, right?
Seven
The
to eight.
saver account.
Yeah.
So then your best try has to be 10, right?
Yes.
If you're taking more risk than FD, that's real
Correct.
risk-free.
That's a risk-free
Yeah.
rate now.
Yeah.
So that's risk-free. You need to be compensated for the risk that you get it wrong.
Precisely.
So if you're getting 5, that's shit.
Yeah.
So shit is not a bad word, right?
No, it's okay. Don't
Okay,
worry.
doesn't matter. It's okay. I felt the passion. So that stays.
Yeah. No, you don't use F word here.
But it is definitely shit return.
Yeah.
So if the benchmark of interest rate at that time was 8, 10 is also
Not
not
the
that great
best.
also.
Yeah, exactly.
Not
So
the
your
best.
minimum is P10 because you want to beat, you hope your company grows also, then you can make more than that.
Yeah.
So a good example is Apple. I mean, we can talk about other stocks. They grew because of their iPhone and also iPad and so they grew, and that's why you can get that 30-40% per annum return because of the growth. So you're buying it for the value and you paid so cheap. Because P10 is considered cheap in today's world, right?
Yeah.
Super cheap actually on this 2022 prices.
Yeah.
Because if you flip the American news, you got AMC doing like no profit and like
That's
you know,
right.
if they had a profit, it would be P1000 or something.
Yeah.
Whatever.
You get all the meme stocks, right?
Yeah.
You get all the meme stocks.
No,
today.
that's where things like price to sales, EV, EBITDA,
And even the price to sales probably like a P like price to sales like 100, right?
Yeah,
So
it's like,
if you
you
if
eye
you
roll,
could
man.
assume that their return on their margin, net profit margin is 10,
Yeah.
so then their PE will be like 1,000, right?
correct.
Yeah.
And that's like you cannot get a net profit margin of like 90. That's ridiculous.
Yes.
Right.
Yeah.
So anyway, but that's
But I mean, in the last 10 years, the valuation game has changed.
Yes.
completely.
Yes.
Right. So what we used to, I guess, preach and practice. If you try and do it today, it's so hard.
Sorry to interrupt this podcast. I know it's a little bit annoying, but I want to tell you something that I think can be really helpful to you. I can tell you're really interested in the stock market and want to learn more about it so that you actually know what you're doing, especially when today things are getting more complex and complicated. That's why we came up with the Stock Investing Blueprint, or SIB. It's our signature e-learning program that teaches you how to pick the right stocks most of the time, buy and sell it at the best possible time, and manage your stock portfolio systematically. It currently has more than 10 hours of content and it's growing. You'll also be part of a group of like-minded investors that can help speed up your learning process. To hop on the program, click on the link in the description or go to learn.firl.co/courses/SIB.
Yeah.
Not only that, I think, in my point of view, I think the way accounting standards have not actually kept up with a lot of the natures of businesses today. So one thing that I think a lot of people who started value investing during your grandfather's time and all that kind of thing were very used to your brick and mortar businesses where you have probably not even omni-channel, single channel kind of distribution, right? And here you have what we call the rise of intangibles. And when you have different businesses, different business models, that's where accounting standards, I feel, have not really kept up.
But I would disagree slightly. I don't think it's accounting standards have not kept up. I think the investors have not changed their mindset to readjust. So for example, what you mentioned, right? So it's more like at a time, a value investor who, if you had studied Warren Buffett and Benjamin Graham in detail, they're not telling you, only buy a company P10, only buy a company net tangible value book of 1.
Yeah, that's right.
They're not actually telling you that if you properly read what they said. They just said, buy something cheap. That's all they said. The buy P10 and net tangible, buy price to book of 1 and buy dividend yield of 5 or whatever. All of that is the other people who wrote about value investing.
Correct.
So actually, if you readjust, if a company we're investing in is growing at 30%, then it's okay to pay a P of 30. So you have to know you have to kind of not to say no because you will never know. You have to kind of reasonably guess.
You got to adapt as well.
What the growth will be.
I disagree with that as well because I feel it's not just the investors have not kept out.
Yeah.
I feel that the way accounting standards have not properly accounted for certain criteria on the balance sheet.
Fair enough. Also.
Because you see, if you look at investors, I think a lot of you would say second, third generation people who have read the classics and all that, they have already adapted. But they also complain that the valuation matrices, like what you mentioned, price to book and PE and all that, may not be the best matrices. That's why I was alluding towards accounting standards have not kept up.
Fair enough. But why do they do that, right?
Yeah.
They do that to push up valuations.
Correct. Precisely.
That's why I'm saying in the last 10 years, the valuation game is out of whack.
Yes.
Right.
And that's where the stories and all this, the way they propped up their stories on valuation makes you go back to what is your anchor. And that's where I think the classics actually do help us anchor. Yeah.
And so that comes back to your point about deep value, fair value, and value. And so we play a very important, when it comes to investing in an MTC, that's the bit that drives us, right?
I see.
Right? We have to keep within that framework.
Yes.
Because the moment we step out of the framework, we jump into this whole world of uncertainty.
Correct.
Right? So it's very important. So that's the bit that, and we know for a fact sometimes when we do this, we're sacrificing short-term returns.
For sure.
And we question ourselves.
Yeah,
right? In the last 18 months, we've said, imagine if we didn't do this, we didn't do that.
Yeah.
Right? Imagine if we didn't do that. But we have to remind ourselves, and that's why Devan said it's about being disciplined.
Yes.
And having basically zero emotions.
Yeah.
You got to be a robot.
Yeah.
Right? You got to be
pure logic.
Yeah. Pure,
rules
and you got to stick to that framework.
Yeah.
Because if you don't, the moment you just step out of it, and we have made a lot of mistakes in the past when we stepped out a bit from that.
Yeah.
Because we were chasing a little bit and go, if we give that a bit more time.
What if, right?
The what if, right? But that's why it's so important.
Yeah.
Right? So that's why it's so important for us as investors, and when we communicate it to our clients and even prospects or anyone that we speak to, the whole definition of deep value, fair value, and value in response to the traditional value play is very important, right?
Yeah.
Because as Devan said, the numbers and the metrics and how people value things now, people have just come up with all this, adjusted that.
And the best part, you guys are global, And that's even worse because in a way, one guy in Scandinavia says, oh no, this is how we do it. The guys in the US will say, this is how we do it, right?
Yeah.
And then it says, oh, if you look at, cloud or SaaS-based business, it's a new model. This is the way we do this. And if you don't have an anchor, that's where...
I have to ask specific to this discussion. I think it's great that this is becoming lively because
this is something, our common friend, we talked to Rondi as well. We discussed about things like
He's doing a good job with the retail market. With
100%, 100% actually. That's where we met him anyway. But I have to ask, with specific to valuation, your thoughts, right? So you mentioned that you gave the example of risk-free rates just now. If you're getting from the bank at 5, you better buy something a lot higher. So when you look at over the past 10 years, let's not talk about the future right now. If you look at the past 10 years, one of the reasons the valuation game has gone out of whack, to some people, it's just what it is the fact that risk-free rates has essentially gone down to 0. And you guys are global. So it's basically 0 or 0.5, whatever and if you want to use the US Treasury as what, it's like 1.5%, 2%, whatever it is. So do you think that feeds into your readjustment? Because let's say if you are okay to buy, if your grandparents or back in the day, they were like, hey, let's get 10% yield because the risk-free rate is 8. So today, if your risk-free rate is at 1.5, I should be okay buying something at 45 times, 40 times earnings. Do you think that's
we don't think of it that way.
Okay.
So I'll tell you, we think of it another way.
Sure.
So what we think about is first is this. If risk-free rate was 10 and you make 10, then you are shit as an investor. If then you must well invest in FD. If your risk-free rate is 5, then you make 10, that's very great because you make double of FD. Right? And if you make 15, that's extremely great. So you have to reset as an investor, whether it's us or our client or anybody who wants to invest on their own, they have to reset their expectation based on risk-free rate, which nobody does, but they should.
True.
So if you just mentioned a number earlier, 0.1%, but let's use Malaysia because we're talking about Malaysia. What is Malaysia's
1.75?
So then if you are making 1.7 times, let's say 2. So 4. If you're taking a 4, that's double. So you did a lot of work to get double, that is great. So if you are getting 5, that means you took maybe too much risk, or either you're damn good. You get damn good or you took too much risk. So people are not thinking that maybe all their returns is too much risk, and they will readjust accordingly because interest rate is 2. So you have to reset your expectation as 1. Now that is reset expectation when you start to want to invest, same like us, when we start to want to invest. So now is the objective of investing to try to beat the FD rate at a higher multiple. Now as a professional manager, you want to beat the FD rate by 3 times. If you're only beating by 2, it may not cover all the costs. Just like you guys are doing. You got this lighting bulb. We also got Bloomberg terminal and all these costs, right? So you want to maybe beat it by 3 times, right? So in that sense, if FD rate, and we're using global, so let's just average a few of the developed countries. And let's say it's 2 or so. So if we do more than 6, actually by right we should be happy. But then we, of course, are not happy. We are trying to get 10. But we're saying sometimes maybe another investor, we're not saying our clients, but just people in general, if they get 10, they should be damn happy. They shouldn't be trying to aim for 20, 30, which people are still trying to aim.
I just to add in there, I think the problem in Malaysia, it's not a problem, is that people don't benchmark it with the FD. People benchmark it with EPF.
Not only that, that's
true. That's a good point.
People say 6% is my minimum return.
Can I give you a glimmer? No, I love your point, and the reason why I'm trying to add to this is because I was a unit trust agent. And the way that it was marketed, if you I used to represent a red color one. So you should right? And their brochure, actually, for all the funds that they sell, right? So you've got your Morningstar, your Lipper ratings. At the bottom was actually a table of the EPF return rates against their fund return rates. And after 5 years, EPF actually stopped it. Because
EPF stopped it.
ETF stopped it. Because they felt it wasn't a very, I don't know what was the reason, but I think
EPF stopped it. The company stopped it. The unit trust company stopped
so
it.
So the EPF told them not to put that benchmark in.
They have that power.
The reason why they were using it is because they were encouraging a lot of people who had EPF money in account 1 to take it out to put it into the unit trust. So I don't know whether they felt it was misleading or whatever. I don't want to speculate what was the reason, but to allude to your point, right? That was their benchmark because EPF was doing so. The problem is how many people actually understand the nuance of how EPF is managed, rather than benchmarking against your FD rates or whatsoever. But I was just, when it was mentioning the benchmarking, right? I was just in my head, I was laughing because try to tell this to the crypto boys because
Yeah.
it's a joke,
No,
right?
no, crypto boys say 2%.
Not just
Are you
the
kidding
crypto
me?
boys. I mean, you talk to
2%.
anybody in the last 2 years that invested in gloves.
Yeah.
Right? Gloves.
But gloves is a
basically-
good example. It came down, right?
Yeah.
But you talk 2020 gloves.
Yeah.
Right? 20-30%, that was little.
It's
returns.
little.
That's nothing, yeah.
Right? You think about it.
Yeah. And I think it's great that you guys raised this point about benchmarking because a lot of people don't know what to benchmark against too, rather than, trying to, compare. And it doesn't help that I think the concept of capital markets in Malaysia, I feel, and maybe correct me if I'm wrong, is still at its nascency in terms of understanding.
For sure.
But that's where the opportunity is, right?
Yeah, that's where the opportunity
still
Hope
is.
the regulators don't watch the show.
No, you didn't say that.
If we get an email, we CC you guys. Look forward to you guys. Yeah, but I want to get a little bit now into individual investments. So you alluded to your story about Apple and your thesis about Apple earlier on. So let's talk about it today because Apple is obviously it's an amazing stock, right?
Yeah,
The largest in the world, essentially.
Yeah.
Buffett bought it. He put in 36 billion. Now it's worth like 160 billion, something like that. So you guys were earlier than Buffett, right?
Yeah.
In that sense.
Yeah.
So, but today going forward, would you still want it in your portfolio?
Well, we can tell you the history of that.
Yeah.
So
What do you
the
say?
sad part is
Wait,
like a
sold
year
it off?
after Buffett bought it, we owned it for 10 years, we sold it off. So we lost out on some of the gain.
Okay,
But
okay.
a lot of people say, ayo, but you know what? Sometimes holding a stock for 40 years, 30 years is very hard. The only person who has successfully done it that I know is Warren Buffett and my grandfather. Okay? The rest that hold stocks for 30 years is not because they were making a decision to hold it, they forgot about it.
Yeah. Yes.
True,
yes.
right?
True.
So true.
I have to tell you this story. I don't know if you know, there was a study. I think you know this story. There was a study in the US, Fidelity.
Yeah.
They actually looked through all their brokerage accounts and they were calculating the returns and they were trying to find a commonality as to why people were having high returns.
Yeah.
Do you know what was the number one factor for the account that the highest returns?
Yeah, all right.
They died.
Yeah, that's the point, right?
Don't touch it, right?
Don't touch it,
Don't
exactly.
touch it.
Coffee can investing, just put it in, pop, and then that's it.
Exactly.
Yeah,
It's
yeah.
So that's
Yes,
why I say
continue.
we are also learning as fund managers or people in the industry, because actually originally we are not in the industry. We're just individuals, me and him,
Yeah.
and my other partner trying to invest. And then we just decided that, hey, let's turn this into a business. Okay, if we are investing on our own, let's turn it into a business and also invest other people's money. So we are not like the traditional you call fund manager or asset manager, a startup, ground up as a research analyst, or like you guys who work in the industry. We didn't necessarily work in the industry. We were management consultants. I was an auditor, became management consultant. He was a consultant in IBM and then later management consultant at Accenture. So we're not from the traditional banking background, but we're just people who like to invest and know how to invest. And I guess the comfort for us, maybe he saw some comfort, was because it was the same case with my grandfather, right? He didn't come for a traditional, I work in a bank and then became an investor. It was just a common sense thing that anybody can do. And like I say, if you read the literature of Warren Buffett and all those, the old school, more of the old school gurus, they just say it's something that anybody can do. And they keep talking about index fund, but people sometimes overuse the index fund.
Right.
Because it's, sometimes the index fund can beat an active manager,
Yes.
but only one country's index fund, the US S&P.
Yes.
If you compare Singapore index fund, no, they are really bad. Zero.
Japan.
Malaysia Bursa index fund, zero.
Try to buy a Malaysian ETF and see your performance.
Zero. So when people talk, like I said, people talk value investing and try to market it and then market for themselves, make their business do well.
Yeah.
People talk Warren Buffett's statement, market it and say, okay, now we're all ETFs.
Yeah.
So they sell China ETF, Russia ETF, this ETF, Malaysia ETF, Malaysia palm oil ETF, this everything. But not every ETF is equal.
Yeah, exactly.
It's just like a fund.
Yeah.
It's just a formula, right?
Yes.
What he was really saying is sometimes if you just bet on the country, the American economy, if you listen to him,
Correct.
then you can't go wrong.
Correct.
If you don't have the time to be a good stock picker, just bet on the American economy.
Yeah.
But he never said bet on the Russian economy.
Never said that. Yeah.
No, he never said bet on the Malaysian economy.
Yeah.
Even Singapore, who's a leading nation in Southeast Asia, who has overtaken all the countries to become the number one developed nation in this region. Their STI has not moved for the last 10 years.
Absolutely right.
It's
Right?
flatline.
So even if you think, I apply Warren Buffett's philosophy and I invest in STI, didn't work.
Yep.
Because you got zero. Then you say, I apply Warren Buffett's thing and I invest in China because China is the next superpower.
Cool, man.
Okay, I don't think it's zero because I can't remember off my head right now, but it crashed recently quite a bit, right? So it's not as great as it used to be. So, and then if you look at the teams that they mentioned before, BRIC, B-R-I-C.
Yes,
That's correct.
Yes.
Only China did well.
Yeah.
India so-so, but Brazil and Russia definitely down.
You know, when the term first came out, Devan, I tell you, everyone
Everybody's
ESG
jumping
lah.
to it.
Yeah.
It's the same as
It is.
ESG, you know.
Yeah,
The
it's
same
ESG
word.
now.
Same with
Yeah,
ESG.
yeah,
same.
exactly.
And then ESG is a bit of a bullshit because shit is.
No.
I've been told it's
You see,
okay.
We agree with this, so please say.
Okay, it's not bull.
Yeah.
Not bull F, so it's okay to use. So because if you looked at the ESG funds that just came out recently, you realize, hey, all these ESG funds, some of them investing in oil and gas.
Actually, you know that the European Union actually came out with a new ruling that's saying that natural gas is considered ESG compliant.
Yeah, which logically should not be.
Yeah, I know, but I was just showing him.
Because every country's or every organization's, there's no global mandate or ESG. It's just a marketing
Correct.
name, right?
Correct.
Yeah.
And then everybody's hooked on to it. So everybody just say ESG. There's no governing, and I don't want to insult necessarily the Islamic funds, but initially the Islamic fund, there was no proper governing body.
Yeah.
So Qatar's Islamic fund criteria might be slightly Sharia. It's different from Malaysia's Sharia criteria.
Correct.
And then everybody is trying to develop and have their own
So
methodology.
there's no standardized.
There's no standardized. So and actually it's interesting because it's the same thing with organic food. And I learned this from organic food. So a lot of things that we do from investing is learning things in real life.
Okay.
So if you went to our website, you ask what is value investing as a nutshell. Value investing is just buying reasonable companies cheap.
Yep.
But then our practice of the firm is buying what you know. And how do you know these things? Is because it's things that you interact with your day-to-day life.
That's
or
right.
things that you're passionate about just in general as a human being. Some people are passionate about cars, they will know better about car stocks.
That's right.
Some people like photography, they would know whether Adobe Systems is a good company to invest in.
Correct.
Or Leica, if they were listed, I don't think they are, or Toshiba, or
Right.
Sony cameras, Fuji cameras. So invest what you know. So it just so happened last time my friends were very into organic food.
Oh, okay.
Yeah. So same thing like ESG. That's how I learned about ESG. Is even in organic food. If you go to Spain, Germany, different reason. What is organic is different.
Classifications all
Classification is different. So maybe as long as it's planted in this region, it's organic. But the moment you move to Spain, it's not organic.
Wow.
So that's the same analogy I can give for ESG. That's how I understood what ESG meant, right? It was the same thing. Every company had their own standard of what ESG meant. So if somebody said natural gas is clean, right? It's clean energy, it's clean and oil.
Yeah.
But I mean, you think logically it's not, right?
It's still increasing the carbon footprint.
You're increasing the carbon footprint, you're digging the thing, maybe it's even worse than displacing the orangutan, right? All the Americans like to say we are displacing our orangutan, but you're drilling. To drill for gas, you also have to drill for oil. It's not separate. It's together.
Correct.
So then you might say that if it's 100% natural gas company, it's not clean because you also had to drill. Your friend had to drink for oil. You know, Petronas gas had to rely on Petronas petroleum to commit all the carbon footprint so they could be clean. So anyway, there are a lot of teams, not to bang ESG, but there are a lot of teams. So that's why you cannot take index investing just in a nutshell.
Yeah.
Right? It depends because sometimes you overdo it.
Yes.
You know?
And that's the worry about overdoing is because if the rules itself are not clear, that's where things get murky. Do you know that they don't even have a standardized way of counting carbon credits?
Yeah, I know.
Yeah, I know.
Yeah,
Every country is different.
It's different.
Right,
It's
yeah.
different.
I know
in oil and
Germany.
gas.
Germany has a very complex, convoluted way of calculating it.
Yeah.
The UK has a very different way of calculating it as well.
Correct.
Wow.
And I think it all depends on the policies of the countries, right?
Precisely.
What works for them.
Correct.
Right?
Correct.
And if they go, for me to get up a ranking list, I need to do this.
Yes.
They will automatically create a policy that will enable them to
Oh, yeah.
create
Yeah.
that, right? So
Correct.
To move up the ranking.
and that's for us. sometimes the stuff that we don't invest in because it's too hard to understand.
And that's where I wanted to dig deeper and ask you. So if there's a theme like this that comes out, hey guys, you know you're a fund, you want to get more exposure or more
Better
that one, right?
PR.
Yeah, and then they said, why are you guys not investing in ESG? I'm pretty sure.
We don't believe in it. Simple.
I mean, we've over the last 5 years. I mean, we started the fund in 2012.
Okay.
From 2012 to 2015, we were practically in stealth mode.
Okay.
Building our track record. Even
Okay.
though we had a track record previously
Okay.
from the family office.
Yeah.
We wanted to be completely fresh, right?
Okay.
So 2012 to 2015 was stealth mode, essentially just looking at companies, buying great companies, generating our returns. 2016, when we started getting a bit more publicity, a bit more, I guess, attention from the markets, newspapers and all. After that, post that, people started coming to us asking us to start funds in a whole range of different strategies.
I see.
Right? Hey, can you guys do Islamic fund?
Sharia fund.
Can you do a Sharia fund? Can you do this fund? Can you do this retail fund? Can you do a quant fund? Right? And I think that's as you talked about the capital markets being very, I say it's still very amateurish, right? People are more concerned, as you probably know, working in the unit trust industry, about distribution.
Yeah. Yes.
So much than return.
Yes.
Right. So in the last 4 or 5 years, we could have grown significantly more from our AUM today. I
Correct.
guarantee you that.
Yes.
I guarantee you that, right? But it comes back to the point of whether we want to accept a strategy that we completely don't understand.
Yeah.
Number one. Secondly, we're not obviously going to perform because we don't know anything about it, which will affect our reputation and whatnot. And that's something we're not willing to do.
Great.
Right?
Yeah, great.
So as a result of that, we tell them we can't do it. Right? So we're back to square one, and we are, as Devan said, we are value investors.
Plain vanilla.
Yeah.
No, just plain vanilla because because I want to ask you a little bit more about this, Don, because what saddens me, because we actually interviewed had a podcast with Tan Teng Boo.
Capital.
And he had a lot of thoughts about it. Obviously, it's going to come out before this episode.
Yeah.
But what was interesting was because I was trying to recollect the reasons why people actually invest and how they get started, and relating to the part about capital markets. Because, correct me if I'm wrong, people who actually come up to you guys and ask you to start a fund, whatever, are very likely high net worth individuals.
Yeah, possibly, yeah.
Yeah, right.
Or institutions.
All institutions. You're not going to get your mom and pops, right? Because they most likely an accredited
But I would
investor.
say they might not say start a fund for me, but they say, in your fund house, do you have any of these funds?
Any offering that is
Offering,
that suits this.
Yeah.
And the reason why I'm alluding towards this is because is it because it's not just the regulators themselves not putting a vibrant market, but because there is actually no demand from the market.
Sorry, I don't understand.
So that means the capital markets in Malaysia is not as sophisticated as what we get in the US or the UK. Is there a possibility that because of the level of sophistication that we have here on our retail investor has not demanded that kind of products to come?
Potentially, but I mean that's what I guess. In some ways, when I speak to your friend Rondi and what I guess Stockbay is doing, that's I guess the education space, right? It starts with the education base, right? Because when if I was to think about our history and our experience of starting the fund, there's a lot of educational aspect that came to the process, right? It was not just making money instantly.
Yeah, because I'm pretty sure some of your high net worth individuals, they may have amassed their wealth from a business or whatever, right? And
which is the case in Malaysia with majority
exactly,
of them.
or inherited wealth, second generation, third generation. And then you start telling them about deep value, fair value, and all these concepts that are probably quite alien to them. Right? And then if you start employing mechanics like, long short, you tell them I'm a long short fund, right? You tell the guy who owns Jim Tire, right? Long short?
No, absolutely. So that's why I say that the education aspect is not as prevalent here. Right? And that's the sad thing, because the reality is people want to make money instantly.
Yes.
100%.
Yes.
Right?
Yes.
So they don't even bother about the truth is nobody actually bothers our product specifically.
Yes.
As in, not our clients, but
Yes.
other people that are interested.
Correct.
It's about, can you guarantee me 20%?
Yes.
Can you guarantee?
Precisely.
What's your response when someone asks you like
I want to see what's your response.
Oh, you're putting me on the spot. Guarantee. I mean, the honest truth is, I tell this upfront. If someone tells you they guarantee you returns, you run away,
Yeah.
right? Because there's no way anyone can guarantee you.
Yeah.
But EPF lah, but that's separate, right?
But EPF is 2.5 ma, statutory is
Yeah,
2.5
true,
only ma.
true,
They
yeah.
can't guarantee you 6% ma.
True.
Yeah.
But the truth is, whether this is a whole range, even high net worth individuals.
Yes, that's what I'm trying to allude to, because we've looked at stats, Don and Devan, is that the more Malaysians, the more BNM actually prints money, the more is being put into fixed D. And
Yeah. They have this money market fund, which I find very weird.
Yeah, and why I'm trying to peel your thoughts about this is that possibly it's because of the level of sophistication. That's why you're not getting the demand for the products or the types of methods that you guys are employing. You know.
So I mean, so first thing I say, education.
Yeah.
Secondly is the fact that people are too in a hurry, right? Impatient, right? Because a strategy like ours,
Yes.
as you call it, vanilla strategy like ours, it takes time,
Yes.
right? For us to get great returns, it takes time, right? And I mean, our 10-year return annualized is about what, 11% now?
Yeah.
12% now, right?
And
If I-
that's in US, so it's ringgit, it's even
Yeah.
more, right?
Yeah.
But if I tell that to someone
Yeah.
who just started investing in the glove stocks
Yeah.
2 years
and
ago,
it's like
There's nothing,
11%. What?
and I've had that. I've had that the last 6 to 8 months.
I wouldn't be surprised.
Right?
Bro.
They go, what? You're a professional manager and you make 11%.
where's your skill, right? They'll ask you things
Wait,
like that.
really? You buy global and you make 11%? That's a bit strange,
Yeah.
right? I bought whatever the big 4 glove makers and I've made 120% in 1 year,
Yeah.
right?
But then it's 11% per annum.
Per
so
annum,
after
annualized.
like 7 years, that is like, double your money.
Correct.
And then
But you see-
after 14 years, that's quadruple your money.
Correct.
And people don't think about it that way.
People cannot think in compound terms.
Correct.
Yes.
So compounding is a obviously we all recognize how powerful compounding can
Yes,
be.
yes.
But the guys on the streets don't think about it that way.
Yeah.
100%.
Right? They're probably like Devan when Devan was 15 years old buying Popular.
Exactly.
Made 100%.
I also was happy. It was
Yeah,
nice
totally.
money.
Right? Probably bought a game or something or his
Yeah.
PlayStation or
Yeah,
something.
yeah, yeah.
And that was it.
For
Yeah,
pocket change money, but still
Yeah.
sell it,
Yeah.
right?
And so they're not constant in the market, right?
Yes,
Being
yes.
constant in market is a completely separate question altogether.
Staying in the game.
Staying in the game,
Yeah.
but being true in the game,
Yeah.
right, brings a completely different picture altogether because of the fact that we try not to do it. We try not to look at the ticker prices on a
Yes,
daily
yes.
basis, but the everyday people on the street, they do that.
Yeah.
And the moment the guys that make 120% and they go, wow, right, I'm going to put more money in. But then all of a sudden it drops
Yep.
100%.
Yep.
And then they're out of the market.
Yeah.
And that's happened to a lot of people in during the 97
90
era,
oh, yes.
right? 97, 2001,
Yeah, they're out
2008.
for good.
Oh,
actually.
yes.
Completely
Exactly.
out. So we've
Yeah.
got some guys that have a lot of cash sitting in FD and all that. I've tried to obviously
Burn already.
right?
Yeah.
You can't get them.
Once bitten, twice shy already.
Correct.
Yeah.
Right? And the problem in Malaysia is whether it's sophistication or just the fact that people are just impatient is they eventually get burned.
Yeah.
And so once they get burned, they're out. So then the capital markets is you're just recycling. Right?
I think that's a
New
very
guys
good
come
point.
in,
Yeah.
they get
Yeah.
burned, they leave. New guys come
Come
in,
in, burn,
recycle
get
it.
it.
Then you get a new group of people, and
Generation,
then now you maybe have a new gimmick.
Yes.
Like
Yes.
crypto and then what's it? Equity
No,
sharing.
3 years ago, there was this thing called Money Game.
Money
Oh, yeah.
game and so many
Right.
things.
JJPTR,
Yeah.
2%.
Right.
My neighbor, when I was in Miri, he was actually carrying the gold bars,
Oh,
I kid you not. Before JJPTR.
I thought they didn't actually give you the gold bars.
Oh, you
Depend
can-
on the.
Yeah, there were a few options.
Ah.
So he took the option where he didn't trust the company. So he actually took the gold bar. So
okay.
he
Wow.
carried
Fair
the
enough
gold
lah.
bar every day with him, And he was a aircon contractor. So he I didn't have the heart to tell him back then that it's like, because I understand the
But even the gold bar is not related. It's like 1 bar, but then he has more in there. That
yeah,
might be lost.
yeah. They actually earn from the spread. That's where they, but hopefully to make you feel better, we actually have a common fund manager friend, and he actually met a high net worth individual, and he said, "What's your strategy?" "Oh, I buy good companies, and after 3 to 5 years, that's how I make money."
I want to double about that.
Yeah, I want to double. And then this guy said, "Then where's your skill? Because you buy any stock, it sure go up."
Any stock will double in 3 to 5 years. It's like,
Yeah, but that's the problem in Malaysia, right? Everything goes up, nothing comes down.
yeah, 100%, right? So I just realized I actually asked you guys about Apple. I'm not sure how we end up here.
Let's come to Apple.
But
Maybe because we didn't want to talk about Apple.
You can ask about Apple.
I will ask about Apple, but
Yeah.
I'll delay a bit because I think how the conversation evolved into managing the fund is really good. So
Yeah.
specifically, right, by being the first ever fund hedge fund in Malaysia, right? What was the process like? Like what is the definition
Of a hedge?
like the difference between a hedge fund and a non-hedge fund, let's call it. And what's day to day like for you guys? We will start with the first question.
An answer, Don?
You can do it. I do a day to day.
What's the first part?
The first question is like,
How do you set up the hedge fund?
How do you start a hedge fund?
That was very
What's
tough.
the difference?
Actually, there's no difference between hedge fund, any fund. It's all just how you name it. The reason why we mentioned the word hedge fund versus unit trust or mutual fund is to differentiate that we are not mandated. So we can do whatever we want.
It's the mandate.
It's the mandate. So a mutual based on Western or American or Australian, the is distinguished by the regulators, i.e. the SEC, which is American regulators. Mutual fund is a mandated fund, so you have to follow what is stated. So it's very strict guidelines on what you can and cannot do. So mandated equity fund, only do equity, only do
Fixed income, whatever lah.
Whatever lah. So very mandated. Hedge fund, anything under a roof, you can buy derivatives, basically
right.
to make money, whatever you want to do. So for us, the only reason we call ourselves a hedge fund or we put ourselves in that bucket is because we wanted the flexibility to do whatever we want.
I see.
But not that we go and short and we go and simply do all commodities. So people get misconstrued with hedge fund because hedge fund actually already started with the term hedging.
Yes.
But a lot of the people who realize, hey, instead of hedging, I make money. I make money from the activity of hedging. Actually, the activity of hedge is insurance. But people say, hey, I can make money from this. And part of that is what caused the global financial crisis in 2008, where people were trying to make too much money for something that should have been an insurance policy.
That's right.
Essentially. And then it evolved where then the guys who were hedging, you found out how to make a lot of money, and then all the top performing funds that could do anything they want were coined hedge fund as the general term. But basically, it's what most people call an absolute return fund, which is the right term. But if you go talk to a person on the street and say absolute return fund, what is
they
that?
look at you like it was
Yeah,
stars.
so it's easy to say hedge
That's what they
fund.
would say
lah.
guaranteed, is it?
guaranteed.
Absolute
Absolute,
return.
right?
Yeah. So it's
Absolutely guaranteed.
to distinguish ourselves from unit trust and mutual fund where we could do anything. So for example, we wanted to buy an Apple. We didn't have to buy the stock. We could buy call options to get. So we want to long it. So instead of buying it direct the equity, but then we can use other instruments to get it.
I
Not that
see.
we would we do it necessarily, but then we want to take leverage. We can also take leverage. So you can take like a 1% loan and buy a position, which we do. We want to buy a country that otherwise you couldn't buy, like Russia. Technically, we can buy. So that's why we wanted to distinguish that we could do it basically anything we want, but then understand our philosophy is actually equity.
Understood.
Right.
Did you face any hurdles because we've got boutique fund management license,
Yes.
unit trust? When you
Yeah,
had-
so yes.
when you went to
first,
CSC, right? And
when
you
we
had to
first
tell
started out, actually, yes, they didn't have a license for somebody like us. So we actually went to Singapore first. And then we partner with a fund manager there. And then we started the fund in Singapore.
I see.
And then only after knocking on the door every year or every other quarter to SE, finally we managed to convince them that they should open up to more than just unit trust mandated funds. Because if not, then everything, all of your money will go to Singapore. That was our pitch to them. That you are coming with, you said our strategy is premium, which is true. But then the way funds also are too plain vanilla also because they're all unit trust. So there are many different products out there that you could go commodity fund, etc. that's not available. So he said, we operate in this universe, but maybe if you open it up, people will stop parking their money in Singapore to access all these other funds.
Yeah.
So I guess then they introduced this boutique license. So then we got our license under the boutique license.
I see.
But I think interestingly, we're the only guys. Is it still
One more.
today?
There's still one more.
One more, is it?
Yeah.
So since then, only 2 people.
Yeah.
And this is in 2015. Because actually, once we started being licensed in Malaysia, we realized there's the other challenging part of the business that nobody sees is running a business and running a regulated business, which is the day-to-day.
The day-to-day.
So actually investing can be very easy, but when you manage other people's money, that's already difficult because you have to interact with your clientele to update them on your performance, etc., your strategy. Because not everybody's temperament is as strong as yours.
Correct.
So if let's say 2 weeks ago, a month ago, Russia invaded Ukraine, everybody's panicking and they're like, oh, should we sell now?
Your phone just went off the hook.
Then after that, China crashed, right? That one day, if you remember that week, all Chinese stocks crashed tremendously.
Yeah.
Mainly the tech companies and many others, but mainly tech. Everybody also panicking, right? Because most Malaysians invest in China.
Correct.
Right? So we have to deal with that. But then we also deal with regulators. So I guess Don can talk more about day-to-day.
Day-to-day.
Yes.
So you're the favorite poster boy in SC right now, I guess, for hedge fund? No, I'm just kidding.
We shall not mention.
Just kidding.
Thou shall not mention. I mean, in my head, the day-to-day isn't necessarily what we go through on a day-to-day, right? Like, I mean, the day-to-day that we, I guess, would like to have is just basically reading the news.
That's right. Reading anything lah.
Spending, reading news, financial reports, annual reports, any submission whatsoever, spending time with clients, explaining to them our strategy, reassuring them the performance of the fund. But that's a small portion, in fact, of what we actually do. And that's where a lot of people, when they start trying to get into the fund industry or the investment industry, realize, shit, it's not as glamorous or as sexy or as interesting as it is.
They probably watch too many Billions.
Correct.
It's not like Billions.
When we watch Billions, I'm like, I don't see Billions.
No, you have to have you need to have a G-Wagon and then a Gulfstream 650. I'm just kidding.
What's the guy in Billions? The
Where?
Bobby
no,
Axelrod.
their compliance guy.
Spiros.
Right?
Yeah.
Think about Spiros, right?
Yeah.
And that's really
That's not how compliance officer is like.
Do you have a
We wish we could have somebody like that.
we
want
are the
somebody like
Spiros.
that.
We are the Spiros of the company, right? And that's the problem, right? That's what the another problem is that the sophistication is not just on the end consumer side, but it's also on the professional management side as well.
Over-regulation is a big problem.
Right? So, I mean, you think about the regulation that the guys have put together in now, right? It's terms and conditions and law from.
Would it be suffocating?
Ooh.
I know. Okay.
Yeah, it is.
Answer me.
I mean, but the truth is, it is.
It is.
Because, like I said, it's law that was designed in the early 90s, early 2000s.
Sarbanes-Oxley.
Right? It hasn't, and it's still so paper based. It's still this, so that. Right? It hasn't transitioned into this whole environment that we're in. Right?
Yes.
And hasn't transitioned to an environment of global investment. That's another problem because we're global managers.
Yes.
And a lot of the guys that I guess
Are local,
SC and Bank Negara regulates are very local. That's a pain point for us as well because
Understood.
there's a lot of things that we tend to spend communicating with them. There's no issue.
Yes.
Nice folks on the other side of the table. But the amount of time spent having to
Re-educate sometimes.
Because it's trying to grow that together with them in a way.
Correct.
Yeah.
But you see, at the same time, no one is doing it.
Yes.
So that's the sad bit, right? So we're
That's why
we're
we say
here.
you're the poster boy.
And
lah.
not only that, we are boutique.
Yeah,
right?
boutique.
We
Somehow,
are not. In fact, our job shouldn't be. Oh no, I'm not saying job. It's never be our job. But our day to day, because we're boutique, we shouldn't be the ones working with them to improve this
This
area
space,
because we don't have the time to do that. We're a boutique.
Yeah.
If we were a large scale guy that came in and then yes, probably. But
ask BlackRock to come educate them.
I have to ask, what are the kind of education that you tend to have to do when you meet the regulators?
so for one example, I can give, and this is nothing to do with investing.
Sure.
So like during COVID, example, they said, where's your BCP plan?
Your what?
Business continuity plan.
Oh.
And then we tell them, actually, when we first started out, we already have outsourced our brokers offshore. We have outsourced our accounting team. A lot of unit trusts, actually, their accounting team is in-house.
Correct.
Yes.
Correct.
We already outsourced everything. So we already have a three-way check.
Yeah.
We already had cloud services in 2012. Everything is either we can all work from home and still trade.
Yes.
24 hours trading we have.
Yeah.
But yeah, and we reply that and they say, no, we need a proper BCP. So your checkpoints, where's your disaster recovery location on site?
But you see,
like
the moment you mentioned disaster recovery, that means they haven't even understood the concept of cloud.
Yeah.
That
That
means
is the discovery.
Yeah,
discovery
that's
and
why-
this we implemented in 2012.
They're still thinking an on-prem kind of, you know.
On site.
And this is 2020, yeah?
But where is
Gosh, man.
Then when you send them the first draft as an example, the first thing they say they still want a proper plan, you know. But also overall we have you can't have a PIC in charge of this. It's not like because maybe I don't know, maybe they took it from a factory or the Chernobyl factory and they copied that one, right?
That was a bit too harsh. I mean, the whole point of the education is educating them that as boutique,
Yes.
as a small investment manager.
And it's resources sapping. I think
Correct.
that's the point you're
Correct,
trying to make.
Exactly, right?
Yeah,
So
yeah.
we have to sacrifice, right? And our resources, our team is not dedicated to the regulators.
Yeah.
The honest truth is our team is dedicated to generating performance, alpha, taking care of clients, making sure our clients are happy. That's the most important. That's the crux of our business.
Yes, yes,
right?
yes, yes.
Without those, there's no need for us sitting here.
Yes.
In a lot of ways.
Yeah,
right?
yeah, yeah.
But you see, as a big bank or a big investment manager or a big unit trust, their job is to make the regulators happy.
Yes.
They have a whole team,
Yes,
a
yes.
team of 20, 30, 40 people managing that relationship.
Yeah.
We don't have that.
Yeah.
Right? Devan and I do that. Right?
Yeah.
And that can be quite taxing, right? On a daily. It's not that we don't do it. Right? So we do it.
I'm pretty sure you guys do enjoy some part of educating. It's just that you feel that it's taxing and it's taking away resources,
Yeah,
right?
yeah.
Yeah.
I
Because
mean, the context of it, let's say it was like a different time, right? So let's say if we sit down, like let's say in September and talk about BCP with them, it's okay. But let's say you're asking about BCT in April when we want to look at how to invest in the market.
And the markets, our clients were
So we will say we will
calling
write,
us.
you get where we
Yeah,
are.
yeah, I
So
fully
that's
understand
So
what
that's the tough part of managing the business sometimes.
They don't get our pain points.
Yeah, yeah,
Right?
yeah,
They'll be
yeah.
like, no, but show us your BCP. And how do you guys operate? We are operating, right? We're talking to our clients. We're still making trades, right?
yeah.
We're going to the
managing
office every
markets,
day.
right?
you know, even
Just
when
because we're not in the office,
Yes.
we're still managing all of that, right?
Yeah.
So that's the hard part.
Right.
And that's really our day to day
Yeah.
in a lot of ways that people don't see.
yeah.
And when we charge our mere management fees
Yeah,
to our clients,
people complain, why are you so high? You know?
yeah.
I have to ask now, right? In your very laborious interactions with the regulators, do you see an improvement? Do you see like they're actually making progress to
I can't comment on
modernity?
that.
the problem, I guess, with the regulators.
Am I allowed
is-
to go to the toilet?
Yeah,
please.
continuing. Go.
Yeah.
You better go before I
Yeah.
get you in trouble. I might drop you in. You try to run away.
That
right?
is an answer. That is an
You try
answer.
to run away. What was the question?
No. Like
Is there an improvement after
Yeah.
all this process that you?
yeah, you feel lah.
In my opinion, I think the problem with the regulators, specifically, I guess SC, who we deal with on a daily basis, is that they also have a high turnover with their people.
So
Really?
So you actually have to restart every time a new guy is on
man.
board.
So they whether it's a rotation, whether they're moving people or talent around, there's a lot of constant re-education, resetting that we need to do with them. Are they getting better? Of course they are. They are getting better.
Yeah.
But at the same time, we have become, or at least our counterparts and the folks in the funds management industry, has somewhat been forgotten because of new things like P2P.
Oh yeah, ECF.
ECF, now digital banking license, more innovative, sexy.
So in a way, the priority
stuff,
has
right?
come down. for
But
you guys.
when you think about the chalk of the market,
Yes.
right, in terms of capital, it's
Yeah.
all sitting with us in,
Exactly.
in that space.
Exactly.
But because it's not as, how do I put it? It's not sexy enough.
Yeah.
That, as I said, sometimes the focus goes into all these newer things that they need to look at for sure.
Yeah,
right.
yeah.
They need to look at all of this because it's important.
Correct.
100%.
But because of that, sometimes that
It
we
just
get
gets
forgotten,
deep.
and then they go, oh yeah, but just no one else complains, right? So just do it.
Yeah, just do
Devan,
it.
the dangerous part is over. So welcome back. That's right. Do you have any more questions about regulation?
I do, and perhaps is it just to paint both sides of the story. I mean, I had some days to deal with the SC as well, not as much as you guys, obviously. But do you think that overall, what is your hope? If you think of a wish list to the SC, right? What is your hope, either one of you or both of you, on how SC can, in a way, help capital markets develop? In a way, if you had a lot of people ask for budget wish list, like government budget wish list. What is
yours?
a capital markets wish list? Where do you think that the SC can make a more vibrant, or Bursa can make a more vibrant, improvement that can help you guys in a way? Because here we are, we try to paint it as factually as possible, but there must be pockets that they may not see now that you guys see. Maybe certain practices that you see in Australia or in the US that we could nibble at it here, that you could help you guys in a way.
Progress,
Progress in the
I think
industry.
the quick one that I can come off ahead, which actually we were talking about to them in 2014 or 13, they should tier regulation, which we were speaking to them in 2013 already. That and that's how the other countries do it. So I think there's in fact they already indirectly do it, but they do it for other reasons, just for data collection lah.
Okay.
But basically there's this distinction between sophisticated investors, etc.
okay.
So then then they should tier regulation accordingly also. If they can determine that some countries do it, the crux of it is based on this idea of sophistication. If it's a Korean, whether it's an investor, they can invest in whatever they want. And so with any asset manager or any participant can create, as long as, so it's just a registration,
I see.
and there's no regulation.
So self-regulation in a way.
Self-regulation because it's sophisticated.
Yes.
So if you think about, if I'm running a coffee shop, yes, maybe you do. I don't really know 100%, but maybe you have to have some food license. But
Correct.
nobody's really checking what you put in the coffee, right?
Exactly.
You could put like the wrong ingredients and someone might get hives coming out of their face.
Yeah.
But it's all self-regulation. Because if you made a coffee that was bad and gave people diarrhea or whatever, they wouldn't come to your store anymore. Self-regulation.
Precisely. Market regulation in a way.
Yeah. So and then we are talking financial market, the word market, right?
Yes.
So there should be more segmentation. Okay, one, we need to protect. They are very important to exist. You need a regulator.
Yes.
So you need to protect all these things. Then you need another segment to say, okay, a different tier, both for the fund managers or people in the industry, whether salespeople, fund manager, agents, insurance company, whatnot, right? Institutions, you need those tiers for them. And then maybe you also need tiers for investors also, where maybe you can't have some rich guy taking advantage over the laws that protect the poor guy and then screw up fund managers also.
Correct.
Right? Because
Good
some
point.
of them do.
Yeah, good point.
Right? It was intended to protect the small little fella that might be misled by the sales agent to buy the wrong product.
Correct.
But then suddenly you get this billionaire that just because the fund underperformed, it never doesn't happen with us, but it could happen. I have observed that maybe it could happen with others. Then this rich billionaire sues this fund manager and says, you lost me 10%, you misled me, even though it was not the case.
Yes.
And then he just sues because he can hire the good lawyers. So then the industry decides, shit, okay, because these rich guys can sue me,
Standardise.
let me standardize and make it so like and then maybe they get the SC to or regulator to help them over-regulate. They put all the 100,000 disclaimers in their thing, write a fact sheet that's actually, or research analyst report that maybe is 1 page of words, but 4 other pages of disclaimers. You
I've seen
don't
those
need
before,
that.
man.
Or
Yeah.
forms that are thick I signed a car loan, you know.
Yeah.
When I buy a car loan, do you notice you sign a form listing?
Yeah, it's this thing.
Does anybody read them?
No.
But that's just because a few rich guys sued the bank at one time and extracted money.
Correct.
Poor guy will never sue.
Yeah, exactly.
Yeah, we have this form. So that is to protect from the guy who could hire the lawyers to sue. Say, you read all these terms, right? But that's not how it should be.
That's right.
So it's about tiering and understanding the difference. That is the main thing. And a lot of other countries has started, and that's how they have evolved from becoming developing to develop. And when they develop, then it's developing in many areas, whether it's that understand that you have to tier things. Tax rate is tiered.
Yeah. Don, maybe just to help you feel better. So there was one feel better about your dealings with SC. Was there's this guy, a guy called Leon Cooperman. I'm pretty sure you heard. Yeah. So he was on one of these the many podcasts I listened about him. He actually mentioned that when
But it's SEC, not SC. Right?
Yeah, correct. But even at SEC,
yeah,
he said that over his years of investing, it was 40, 50 years, right? He said that the composition of board members, was it JP Morgan or Goldman Sachs? I can't remember. He was one of these. He said,
I think it's Goldman. I think.
Goldman, right? When he started, there was probably one lawyer on the board.
Yeah.
Today, 60% of the board members have legal background. It's because it has changed to be over-regulated. So even in Malaysia, we're facing this. SEC is also facing this. So hopefully it feels better.
No. So I mean, part of that, part of the improvement is maybe more guys from the industry into the regulation.
Precisely.
Less so lawyers.
Yes. Right? Because you don't want to stifle capital markets.
Yep.
The regulation is there. If we were to simplify, is to protect the guy on the street so that he doesn't.
Yep.
But then
100%.
when you are overprotective, then what, you kill the vibrancy of the market.
Yes.
Then why have the capital markets in the first place?
Right?
Yeah. So
And then there's some weird thing with overprotection also because you really can't protect everything.
yeah.
So because law is not created overnight, it's created over years, right?
Yes,
so you
yes.
overprotect on something, then a new thing pops up like crypto,
Yeah.
and that's not protected also, anybody can do. So then actually the guys on the street are also killed.
Yes.
Yeah.
Precisely.
Because you have adopted a philosophy of overprotection.
Yeah.
Because overprotection takes time.
Yes.
So you cannot protect something that may be harmed immediately, and then you don't protect that.
Yeah.
So
And usually the regulations happen after the bad thing has already happened.
Yes.
Yeah.
So it's an after. It's a
retroactive.
knee jerk.
It's always it's not proactive. Right? It's always a reactive.
Correct.
So your
Exactly.
point is right. I mean, the US also faces this problem.
Yes.
But I guess we are not advanced as the US, so we take longer. So it's true. I mean, it will be harder for our regulators.
Yeah.
Just in general, because they have to get up. So it's not their fault either.
Yeah.
But of course, like everybody, we should aspire to be better.
That's why I was asking about.
It's not to say that SC is bad. They're actually quite good.
Yeah.
I mean, we are. I have not read about Vietnamese or Myanmarese capital markets regulate law on capital markets, but I'm sure we are much better.
Well, yeah, definitely.
Right?
Yeah.
But I'm just saying this because we are much better than the next guy doesn't mean we cannot be better and benchmark ourselves.
We
to
should
number
benchmark
one.
as the best and then aspire to be there rather
Close
than
the gap lah, at least.
Yeah.
Yeah.
Keep on closing the gap. That's what I'm saying.
Yeah.
Okay. So enough about the
Back to
regulatory.
Apple, is it?
Yeah, enough about the
Back to
sad part.
stocks.
Yeah, back to stocks. I don't know whether
fun
this is
part.
a sad or fun part. But,
Yeah,
It's fun. It's
Apple.
fun. Anytime you talk about stocks, it's
You
fun.
guys,
But yeah.
you guys exited Apple in 2016, 17 that you mentioned.
No, we exited in 2018.
2018. So,
Yeah.
but was it a full exit or
Full
partial?
exit.
Okay, so today will you buy it? I guess.
Okay, so the reason we exited
Yeah.
means today we cannot buy, right? Because it's a full exit, right? If you're understanding the logic.
Yeah.
The logic of us, we invest for the long term. So what was the decision-making process to decide to fully exit? I guess should use the word obviously. At that time, we felt that it was no longer a long-term holding, so we exited. Now, of course, sometimes the tough part about investing is knowing when to sell, right? When to buy also is equally as challenging, but actually when to sell is challenging. But actually what people don't really say is not when to sell, it's when not to sell. That is the most challenging out of
Absolutely.
everything.
You said like your report on fidelity, right?
Yeah.
Best
Yeah.
performing guys are the guys that did.
Yeah. So every time it's asking when to buy, when to sell, when to buy, when to sell. They forget to ask the question when not to sell. And then it's a different question. You think it's the same thing, but it's not. So, but that's always challenging. And so we owned it for 10 years and we somehow decided to sell because maybe we were asking too much when to sell. And we decided to sell. And then it continued to do well. We missed out those returns. But sometimes in life, you just have to accept it. You cannot get the full wave.
Yes.
You know? It's very hard. If we read a lot about this other, you could say, value investor, Howard Marks, and he talked about it in his recent article recently. Anybody who had bought Amazon, or most people, when Amazon went up 1,000% would have sold it already.
Yeah,
They
exactly.
wouldn't have kept it to 10,000%.
Yeah.
Amazon, if you owned it at in the 90s till today. But if you did, you didn't need to own any other stock. The great Bill Gates actually has less, I'm not sure whether it's less, could be less, I may be wrong. But in around early 2000s, he sold half of his Microsoft shares, which was a good decision
At that
to
point
be
in time.
At
in.
that point, okay.
It still is a good decision. It's the right move to make. You have to diversify.
Yeah, yeah.
Because I can tell you a story of another successful billionaire who sold his shares and that was the right decision. So he sold half his shares and invested elsewhere to diversify. But because Microsoft is such a great company, it did so well. If he kept his share, he'll be richer than Elon Musk today.
Yeah.
But actually,
Yeah.
not only will he be richer, he gave a lot of money to philanthropy. So I think alone, if he didn't give money to philanthropy, he will still be richer than Elon Musk today.
Yeah.
But if he didn't sell his shares, maybe he will worth even more than maybe 400 billion.
Yeah.
Maybe.
Yeah.
Because Microsoft turned out to be the best stock from the time he sold it till compared to many others. It grew like maybe 1,000%, right? Whereas his other maybe it grew 500%. His basket of diversification portfolio. So even he, the owner of Microsoft and the founder, sold half his shares. But it was the right move because he had to diversify. Because the law of diversification, or you say law, but it's a good philosophy to have because it started at the times of war.
Yeah.
And now it's being reminded to everybody with Russia-Ukraine war. Is that back in the days, we are lucky because we never faced war, but our grandparents faced war.
Yep.
So when you faced war and you were the unlucky nature, you lost it all.
Yes.
Yeah.
So that's why the concept of diversity came to the picture.
Yeah.
And when you talk about the financial markets, you talk about America likes to, when you read the Wall Street Journal, they always Great Depression. That was 1932,
Yeah. Yes.
before World War II.
Yeah.
Right? So financial markets is so developed in the 30s, but yet people can still lose everything because of war. Lucky America won, right? For the American stockholders.
Yes.
But if they were a German stockholder when Germany was a top nation,
Yeah.
today Germany's the top nation in Europe, right? And then France is second. But imagine Germany got another war, right? then you only own German stocks, you will lose quite a lot.
Yes.
Same like Russia, right? So you have to buy diversified. So the concept of diversification is important, and that's why Bill Gates practiced it. Because he knew you can't have all your eggs in one basket. You can have a few eggs in a basket and protect it very well. So even Warren Buffett doesn't just have one stock.
Yeah.
People keep saying he has one stock. But actually, if you look at his portfolio, he has actually maybe 30 stocks, but it's concentrated to a few, but that's still Coca-Cola. Then recently you mentioned Apple.
Yeah.
So it's still not one. So
Yeah.
what Bill Gates did was correct, where he diversified it. Another example I give is Mark Cuban, where Mark Cuban, he sold his company Broadcom to Yahoo. His partner didn't sell his shares. He sold everything, diversified it, and he's still a billionaire and he owns an NBA basketball team
Dallas
called the Dallas Mavericks, where his partner is no longer a billionaire. Because he went down.
He hedged his Yahoo shares also, if I'm not mistaken.
Yeah, but I mean, the main thing is he decided that I'm not going to just keep Yahoo. I'm going to diversify it. Hedging is an attempt to diversify it. So that's why. So the concept of diversification is correct. Bill Gates is still richer than he was in 2000.
Yeah.
Right?
Yeah.
So it's not wrong. So it's probably a mistake that we sold Apple too early. Actually, the main difference was Apple moved from a PE of 15 to 40.
So that was one of the triggers.
The main catalyst of the stock share price jump. The earnings growth actually has been single digits.
Yes.
Only
Yes.
recently has it been double digit. But generally, if you compare to 5 years ago, the earnings is not double of 5 years ago. Which is when you asked about Microsoft earlier about Steve, I think you
Steve
mentioned
Ballmer, yeah.
Steve
Maybe you
Ballmer.
can talk a little bit
Actually,
about-
during Steve Ballmer's tenure, he tripled Microsoft earnings. Nobody remembers that because they only look at the share price.
Yeah.
So he says he's a lousy CEO. Actually, he's a great CEO. He tripled Microsoft earnings. And I think he also more than tripled their revenue. So how can you say he's a bad CEO, right? Most people say he's a bad
Yes,
CEO.
yeah, okay.
So I keep defending him. I say, no, he's not a bad CEO. He's a great CEO. He tripled the earnings.
Yes.
A lot of CEOs don't triple the earnings. They triple the multiple, but that's
Yeah.
not the same.
Yeah,
Correct.
yeah,
Right?
yeah.
So actually, he's a great CEO. Maybe he's a bad stock salesman.
I think I was coming from the point of
Yeah, but I can understand where
Yeah,
most people are coming
yeah,
from.
yeah.
But actually, I had to say, so that's the difference between value investing and all the other forms of investing. In a sense, we look at the business, we don't really care about the share price.
Great.
We want to understand, can this business, Apple, in the next 5 years, double their earnings? And so that's probably why we sold in 2018. We didn't think it could double its earnings, but we were proven incorrect that triple the share price. So sometimes we have to also learn not to sell too early, ride the momentum a little bit more. But that's always a tough thing.
Yeah.
just to peel a little back on that decision-making process. So it's between both of you, and I'm
It's
guessing
not just, we have another partner.
Okay, so between the
called
three
Aaron.
of you, what is the framework for deciding? So let's just say you came out with the suggestion that, I think it's a good catalyst to sell. How is that debated?
Yeah.
And how is that framework actually
Is it a
debated?
democracy or is it single trigger puller?
Yeah,
What is it?
Generally, we discuss everything together.
Okay.
And then I would have a bigger say, but generally we all come to roughly the same conclusion.
Okay. But has there been heated debates? And then debates are
course.
actually good. It's
Of
good.
course. Yeah.
It's good, right?
Yeah,
But what has been, besides maybe Apple may not be a good one, what has been the most contentious stock?
The most
that you-
controversial position
Yeah.
or lack of.
Let me think.
that you guys like really fought it out, and then in the end you made a
Maybe you
decision?
guys have
I can't
different
mention
answers also.
the name. But at one time we were testing a very small portion on shorting. And using the derivatives and options and etc. to gain very just a small little option, and then we tested a little bit and then cut loss.
Okay.
But thankfully we already knew the lesson, but thankfully we relearned our lesson. Don't ever short.
Okay. Was that
We didn't lose any money from it.
But to your question,
Yeah.
we have lots of very strong disagreements, but that's important.
That's important.
That's absolutely very important.
Yes.
Dave and I have very different mindset.
Yes.
Devan looks at it sometimes very, very detailed,
Okay.
right? And as he said, you said before, economics is not investing.
yes.
Yeah.
I studied economics.
Yes,
right?
yes.
So I'm a very macro guy.
Yeah.
Between Devan and I'm more of the macro guy.
True,
Okay.
true.
I like to read about
guy.
whatever that's happening with the inflation, the rates, whatever around, right?
Yeah.
And so I will have a very different perspective on when he says, let's sell this or let's buy this, right? And we will come to a disagreement.
Yes.
But that's where the magic happens.
Yes.
Right? Because when everyone's on the same page, no one plays devil advocate.
Yes,
And
exactly.
you don't get the bad or the good.
Yeah.
Right?
Yeah.
So the idea is not to disagree, but we disagree.
Yeah.
Because of the fact that we don't have the same opinion.
Good.
We don't have the same opinion.
Fantastic.
He comes from a very different perspective. I come from a very different perspective. But when we layer everything up,
Yep.
we get a much better perspective.
For sure.
Now I can remember something. So just recently during when Russia invaded Ukraine, and then he being more of a economist, macro guy, he said maybe we should trim down the portfolio a little bit because it's really bad, right?
Yeah.
And then so there was a big debate because if you had trimmed down your portfolio during COVID time, which was my sort of argument as we were debating, you would have lost out because it was a V-shaped recovery.
Yes, that's right. That's right.
But everybody would say this is the worst time to trim. And in fact, we trimmed quite a bit during COVID time and lost out on a lot of gains because we held cash during COVID. But we always were on the philosophy of being safe rather than just trying to get the highest number, right? So some fund managers go for the highest number. if it's not their, if it goes bankrupt, so what? It's not their
Yes,
money, right?
yes,
so,
yes.
But for us, it's our money.
It's our own money, right?
Yeah,
so,
exactly.
Yeah. So we hold cash. So this time we were debating that, and he was like, maybe you should trim, and I was saying, no, we don't want to repeat the same mistake in COVID, and then we decided we came up with the right same decision, and we decided to trim a little bit, and then because of trimming, it gave us more confidence when things crash much to just go really big in certain stocks.
Yeah, it's
You
good.
know,
It's good.
whereas if we didn't trim, then we will ask ourselves, oh, if we buy these stocks, maybe, and then when we buy something, we use leverage, and now we are a bit levered.
Okay.
So we lever around like 20-30%.
Okay.
So then we will be like, if we can't because then we use lever. We never ever want to have a margin call. So we never ever. So then we wouldn't have bought because if we had bought, we could potentially get a margin call. We were wrong.
I see.
So that's why we trimmed.
I see.
Yeah.
I see. Coming back to this as well. So while you guys discuss and debate, right? Do you guys like actually keep a journal of how?
It's okay off the record.
You can say no comment, but I'm just very curious because, like, a lot
You
of
want me to
times.
answer this or you answer?
you can answer and I can add on. I guess.
So the reality in investing, is all the mind and the experience.
Yes.
When you work in an investment firm or any company, there's a lot of paperwork. Okay, people want to see paperwork.
Yeah.
They think that's work, but
Yeah.
work is not. Thinking also is work.
Yeah,
Reading
it
also
is,
is
it
work.
is,
People
it is.
discount that.
Yes.
So when we even sometimes when we have our juniors working with us, they think just because they do the work they can pick a stock or they build a model they can pick a stock.
Yeah.
A lot of it comes investment over years. So like for example, you discuss Apple. Apple is not the only stock I personally know very well. And he knows some other stocks like BHP in Australia and mainly Australian companies because that's where he came out that I know nothing about, right? And that comes over years of looking at the company,
Precisely.
following it, reading about how they reacted at that time when oil price collapsed in 2016.
Correct.
You know how they reacted then, how the managers reacted, how the market reacted. So there's a lot of things that you cannot get if you just do a DCF model today,
100%.
or you just check the PE ratio today, or read the research analyst report today. So a lot of our experience come from talking, debating, reading the annual report. So we actually don't really journal, to be honest.
Yeah.
We don't do that journaling practice. It's all up here.
Understood. It comes to experience, a more verbal kind of experience.
Yeah. And then we keep it up here, and it's just me, Don, and then we have the other business partner, Aaron.
Understand.
And so we all have our memory since then.
I see. Yeah. No, I was thinking that, in a way, how do you, not the same measure, how do you actually relate to another scenario that may happen in the future, and how do you actually in a way inculcate certain practices or culture to the next generation?
I'll say we have good memory. but
as I say,
if you're talking next generation, maybe besides the three, besides
yeah.
us
So
today,
developing
I
leaders.
we're not thinking so far. I'm not thinking so far ahead.
to answer that question,
Yeah.
we don't buy and sell a lot.
Yeah, I agree.
The turnover must be very low.
Right, we don't buy and sell a
Yeah.
lot, right? Like even if we do, it's mostly rebalancing positioning and here and there, right? But to completely come in and out, we don't do that a lot. Right?
Understood.
That's against I guess what we want to do, right? So there are instances like selling Apple, right? And we play that back over and over. We talk about it over and over.
Yeah.
Repeat it so many
Right?
times.
Over coffee, over drinks, over lunch, over dinners, right? And that will constantly, when we come into the next decision-making process, we'll talk about that. Obviously, COVID was a big component of that thought process, right? We in that 1 month from basically March to April, right? We were just basically trying to think of what we need to do. And we were trying to draft BCP plans as well.
But I don't know, maybe he can speak more about that one. On COVID, I was a bit less worried. So I'm not sure about. But
I mean, we were not completely stressed, but to think about do this, do that, right? What the cost effect is, right? We buy now, or you sell later, or you sell now, you buy later, right? What's going to happen in the short term? What is going to happen in the mid term? What's going to happen in the long term, right? And what we always do and we tell clients this is that no one has a crystal ball,
Yeah.
right? No one has a crystal ball, right?
If any
So,
investor tell you he's certain of the future,
yeah,
I said
12 months from now, 6 months, I can tell you what's going to happen 6 months. No one can tell you what's going to happen
Yeah,
6
no,
months, right?
yeah.
I mean, I still have research reports of guys in our local industry, local brokerage, sell side, saying that Top Glove was going to be $300 or $400.
yeah.
Nice.
Remember
I still have that. I'm looking at that. I'm going, wow, right? Such a big call, right?
Yeah.
Such a big call to say it's going to be $300 or $400.
Asia target price at 0.
It's one for
Oh,
the...
someone said that.
Yeah.
Really? They put 0?
Yeah.
Okay, just to let you know, the why we go to equity, right?
Yeah.
Because equity can never go to 0. There's always a salvage value.
Yeah, exactly.
Right? So that's why we go equity. The worst case you can lose is not 0.
Yeah.
And sometimes you just lose 50. It's not too bad. At least you lost 50.
Yeah, exactly.
Whereas other things, like you run a business and you open a coffee shop, you're really bad.
Yeah.
You lose all the money.
You can be negative.
You can be
actually, though,
negative.
right?
Hey, you're right.
Yeah.
You can be negative. You're right.
Yeah.
So that's the good thing. So yeah, I'm surprised someone wrote 0.
Yeah. But you know, it's one for the museums, right? These are-
Yeah. What you said.
One for-
No, because it's, for me, I find it sometimes very hilarious because these were how audacious the call was.
Yeah.
You can either go big or go home.
Yeah,
Right?
yeah.
But at the same time, what was the reasoning and the thought process behind it? That's where I want to
I
keep
think
it.
there's no thought process behind it, in my opinion, and I don't want to insult another peers in the industry. But sometimes that's why Don mentioned earlier distribution versus investment. Some people are focusing too much on distribution, so they need to write what sells, right?
Yeah.
But we're not talking about a movie or a storybook here, right? We're talking about you are writing that something that's going to influence somebody to make a decision on his life. So you have a chance to influence somebody to be either rich or very, very poor. And so almost in a way, you could say unethical. But I guess in the quest to make money, not everybody is ethical.
Yeah.
100%,
It's a
100%.
choice. It's a choice.
Okay, this next question, right, is going to be controversial, right? Because John knows what, because the questions, he knows the questions. Probably the hottest stock in the past 2 to 3 years is Tesla. Now, I'm not going to ask you too much about Tesla, but I'm going to ask you about your positions in the traditional autos.
Oh, yeah.
Okay.
I believe that's something that right now you talk about traditional autos, you have to talk about Tesla, because I think there was one comparison you made in your latest commentary. I believe that you add all of them together, the market cap is still smaller than Tesla. But I'm not sure whether with the dump now of Tesla, whether that's
But actually,
true.
Tesla went back up as of today or this week.
So I think it's quite a contrarian, or it's quite an unpopular decision to get into the traditional autos right now, from where I sit, because obviously Tesla is eating everybody's pie. So what is the case for the traditional autos?
Actually, we invested in traditional autos in 2018. And then we doubled down in 2020, just before COVID. Just before COVID. And what was interesting actually was we never thought any car could sell. But people were buying cars during COVID. So anyway, we made money on our traditional autos, but we didn't keep it because we thought it went back up to a level where it was no longer value to us.
I see.
It was no longer deep value, because at that time it was, in our opinion, deep value because of Tesla. Because all the money that went to, we talked about teams earlier. So the people who wanted to invest in autos didn't put it in traditional, they put it in the EV makers.
Understood.
So all the investment dollar from funds went to like the Teslas and the Neos and etc. But our argument was the same then, that a traditional auto can also make a EV car. And it's proven today. Tesla, fortunate for them, only Tesla, and that is my view, is that only Tesla has succeeded.
I see.
Nobody else will be able to succeed on the EV space, on a pure EV not coming from traditional auto. Because Tesla was the first mover, and if you look at their product, it is the way they did it is excellent. They have the best range, the way they retooled their factory. They were willing to do something that nobody else wanted to do. They took the most risk. So with big risk comes big rewards. And the reward was they finally achieved scale.
Yeah.
So they can be profitable. Whereas all the other guys, Neo is just a PowerPoint slide. Rivian is not a PowerPoint slide. They worked on it, but they couldn't get that because they're still a bit conservative. They're not sure whether they want to fully go in. Whereas Elon Musk say, I'm going to fully go in. I don't care what the business book says. I'm just going to build a factory like this. I'm going to build a gigafactory. And it works, so now they can be profitable. But it's a lot of risk. So as a value investor, you cannot touch that. If I'm touching that, then we are fake. We are not value investors. So that's why we never touch Tesla.
I see.
Because then we will be fake. So we cannot touch that because every Tesla, there is a genuine company like Nvidia that also went up 1,000% in the same period that Tesla went up.
Yes,
and
yes.
that's a profitable company.
And a more proven historical track record.
Exactly.
Less risk.
Then there's and then Nvidia is one big hot stock. Then there is another turnaround strategy like AMD. So there are many different companies. Apple is another example. Okay, maybe Tesla went up 1,000%, but Apple and Microsoft in the last 5 years went up 400%.
Correct.
So you don't have to get all your returns from this like one speculative stock. You can make a good return. And like I said, as long as we're beating FD, we're trying to make the best we can.
Yes.
We're not trying to say, I'm trying to make 50%. I'm not trying to force a number here.
Yeah.
We're trying to get the best number we can at this level of risk.
Yes.
So we felt at that time, all the traditional guys had a good risk reward to ratio because they can also make EV. To give you an example, Ford, if you track their share price in pre-COVID and post-COVID and the bottoms of COVID, if you decided to double down on Ford last year outperformed Tesla. Just Google it. Ford, I think Tesla, I can't remember how many percent they did, but Ford last year, 2021 return did better than Tesla.
Wow.
Because the market is now rewarding Ford for their EV progress. Now, I think now maybe Ford is a bit overvalued because I personally don't like EV. I think it's like could be maybe not a fad per se, but it's ultimately when you invest, you want to invest in a business that returns money to shareholders.
Correct.
In the long term, that's what you want. In the short term, you can speculate. But if you're keeping it for 10 years, ultimately you want to receive your money through appreciation, the share price, which is a factor of its equity book value,
Correct.
or what it's worth, or you want to get a dividend. And so therefore, we just still think it's a bit overvalued. Tesla, we have definitely thought it's overvalued since I've definitely, since day one till today, I am not a fan of that. But it doesn't mean another person cannot make money on Tesla.
Correct.
Right?
Correct.
So for the person who made the money on Tesla, great, good for you. But the person who's going to say, I'm going to buy it today and make the same return, just remember the guy who made his money in Tesla made 1,000 because it started at this price.
Yes.
Do you think it can at $1 trillion it become, if you want to make 1,000% again, what is that?
So you
10
work,
trillion.
10 trillion.
10 trillion. So you better
Yeah,
work
That's
backwards.
half the US
What's
economy.
Yeah.
Yeah, so then it's 10 trillion, right?
Yeah,
so you also, when a company is too big, you cannot grow that much anymore. So same with Apple, same with Microsoft, their growth rates were slow. You know, you have to accept that.
Yeah.
So if you look at Facebook last 5 years return is paltry.
Yeah.
I think it's like less than 100%, right? And it's like a darling stock, right? You think about it.
Yeah.
But then in the if you take the 5 years prior, so means now it's 2018 to 2013 to 2018, the growth rate is like
Phenomenal.
300%,
Yeah.
400%.
Yeah.
Right?
Yeah.
So at one point it was slow. Same with Google. You look at Google, the reason Microsoft and Apple did better mainly because they actually did a very good job in growing their earnings somewhat. But their main reason was the multiple expansion. Microsoft and Apple at that time were traded around P of 10, hovering between 10 and 15. So they multiple expanded to 40.
Yes.
Yeah.
Yes.
And then we go back to a story about Steve Ballmer's tenure.
Yeah.
When Steve Ballmer took over Bill Gates, he took over Bill Gates from Microsoft when it was a P of 80. So the P shrank from 80 to 10.
Yes.
So even though he tripled his earnings, the share price didn't move. But at least it didn't move, so he never lost any money.
Yeah. Yeah.
So, you know?
Yeah. I think it was 16 years after the .com crash.
Yeah.
16 years later only then if you had buy and hold, right? Only 16 years
They
later
reached
you
the
made
high.
But then if you buy and hold till today, you still ended up with maybe a 10% return? Maybe?
yeah, probably. Yeah.
Right?
Yeah.
So it will not be, that's the thing. If you die, sometimes you make a better return, right?
Yeah.
So the buy and hold is good, but then sometimes it's very hard. So
Yeah.
sometimes it's
Hard.
harder for us because we're now in the industry, right?
Yeah.
Everybody is saying, hey, where's your month-on-month return?
Yeah.
Because we send client reports on a monthly basis, right? So they like,
Why,
Why?
yeah. right?
Why?
Exactly.
Yeah.
As in, why do we send it on a monthly
Why on
basis?
a monthly? No, why not on a half yearly or a yearly?
It's a demand of what people want to see. They want to see a statement every month.
Oh, okay.
Yeah,
but you
yeah.
don't write a long
No,
commentary.
commentary is quarterly.
I see.
But you see your monthly report, like your
I see.
statement every month.
It's like
I
a
see.
bank statement, lah. Your
And
monthly
then the
bank
value
statement,
goes up
right?
and down, right?
Okay.
Yeah.
And
So
what-
initially we used to fluctuate. We used to on ourselves we shouldn't have, but we're all human beings.
Yeah.
When our month goes down 10%, we also shit.
Yeah.
Right. We feel like negative. Now we don't feel it anymore. But at one point in the earlier days we did, because then our clients said, "Why are you down 10%? You say
Yeah.
you're making 10% per annum.
Yeah,
but you're
yeah.
down 10% in 1 month."
yes.
So so we also felt it in the early days. So sometimes maybe we tried too much to manufacture the month-on-month returns. But and when you try to manufacture, so let's say like a Microsoft, right? Maybe you had just kept it, you have made your money back.
Yeah.
But then you try to manufacture, okay, I sell it, may not, I buy something else. The something else is not a Microsoft.
Yeah.
It's not even an Apple, it's not even a Google. Maybe it's a BlackBerry.
Yeah.
Maybe it's a Nokia. There are not few great companies, you know? So for every Tesla, there is a Rivian. Not everybody bought Tesla, right? Some people saw
Correct.
Tesla went up 500%. Now it's up 1,000% from, I think, 5 years, right? I can't remember. Don't quote me on this because I don't memorize Tesla's numbers.
Yeah.
But I would say that a lot of people said, oh, Tesla only went up 500%. I'm not buying now. I'm going to buy Rivian and Neo and Nikola.
Hopefully it
and
can become a
the
Tesla.
new Tesla, right?
Yeah.
But not everything is Tesla. That's why I said Tesla is the exception. You have to
Yeah.
give a lot of credit to Elon Musk.
Yeah.
That he turned it into a legitimate business. But Neo and all those guys, they're all like Neo. Is it Nikola? Nikola is fake, right?
Yeah.
Yeah, it's a con job.
Yeah.
Yeah,
Don, on this same topic about a particular stock, I think, what do you think was a good lesson learned from a stock in your portfolio, and what do you think was, in a way, some sort of a luck in the sense that maybe you saw 10 things, you saw 7 things that you were sure of, that you had a conviction to actually put into, but then 3 things that were like, oh, this turned out well, and then only 1 thing didn't turn out well, kind of thing.
It's a bit hard to say where luck comes in because you need luck
Yeah.
in every turn of the corner. You need luck, right? So in Tesla's case, in Apple's case now, it's PE expansion.
Yes.
Right? Sometimes you need that PE expansion.
Understood.
You flip it on the other side, you could buy a Microsoft, which, as Devan said, great company, earnings growing,
Yeah.
revenue growing, PE dropping.
Yeah.
PE ratio shrinking.
Right?
Right? As a result of that, you don't get an increase in value, right? It's a bit hard. So from our perspective, that's why we say we don't tend to look at the share price too deeply,
Understand.
right? Because the moment we start doing that, then we start not speculating, or we start thinking, oh shit, is this deep value, is this fair value or not? We try not to get into that game,
Understand.
right? So for us, we buy a lot of the companies, and after we have a thesis of why we invest in the company. So for autos, for example, as Devan said, when we looked at autos in 2018, we studied the whole industry a lot before entering the market, right? Right. And for us, it was because the thesis then was that apart from Tesla, these guys can get into the EV game, right? And some of them are producing other cars that are already generating cash flow positive for the business.
F-150 for Ford, it's a ubiquitous
the
car
truck, exactly, right?
in
The
the
best
US.
truck
The
they
Porsche taken.
Yeah,
right? All of them,
exactly.
right? All of them. So there's a certain thesis that we put, right? But we got to let it ride. So we have to let our thesis ride out up to a point where once it becomes, okay, it seems like the valuation play now, after 3 years, don't make sense. Then we can say, we exit. And most of the time, thankfully, we exit with a bit of luck and we double our money, right? But you need that luck at every corner.
Yeah.
Otherwise, you're never going to be able to get some sort of good returns, right? So the underlying component is about buying the good companies that have, as you said, the first filter.
Yeah.
Good PE, good PB.
Yeah.
Right. Sometimes some of the companies, more the tech companies, have a good PEG as well.
Yeah.
And all of that, right? So good balance sheet, etc. Cash flow, right? Cash flow is very important when we look at it from our perspective as well. And then you got to let it ride. right?
I understand.
You got to let it ride. I mean,
Yeah.
those guys that invested in Microsoft, sadly, they were just unlucky.
Yeah.
They were just purely unlucky.
Correct.
But those guys that got into Microsoft 5 years ago,
Yeah.
very
lucky. That's why I
Same
think.
company, no?
Yeah, same company.
Exactly the same company.
I think it's not so much the quantitative that I'm looking for. It's more like the qualitative in the sense that we got luckier. There's no skill to it, just got luckier on certain stocks than on some.
I mean, there was a consumer play that we had in the States, and it was falling because of a plague in one of the stores.
Ah, okay.
Then eventually, it just bounced back up. Purely because of the fact it was just
forgot about it. Something like COVID, V-shape.
it just basically just shoot up.
Okay.
Even though I think COVID is a terrible problem, big dent on the global economy, but it seemed like as if it's not.
Yeah.
So so even exactly actually COVID is a good example.
It's luck.
Right?
Yeah.
You think about it, the quickest recovery ever.
Yes.
5 months, something
Right?
like
The
that.
quickest recovery, right?
Yeah.
I mean, I know this for a fact because when we graduated, graduated in GFC.
Yeah.
2008.
right?
Okay.
Very bad time.
Yeah.
Right? And that's when I started really buying stocks, right? Because paycheck, salary coming in.
Yeah.
Right? And that's when, even though I was buying great companies, great cash flow, great financials, it was just tanking
they're not
every
moving.
day.
You would have to wait till probably 2012.
It was an 18-month recovery,
Yeah,
something
long.
like that.
Yeah, long,
long.
very long.
Yeah.
Waited 2009, nothing.
Yeah.
2010, then you start seeing a bit of a recovery, right? But then you lost 2 years.
Yes.
Right?
Opportunity cost.
Then you
but-
might have think, oh, you're lousy, give it
Yeah,
up.
exactly.
But so I mean, for us, when we looked at 2020, in March 2020, we were like, shit, imagine it was the GFC.
Yeah.
Imagine 2 year, 3 year recovery, and
Yeah.
and this was going to be actually worse.
Yes.
The GFC was America.
Yeah. very-
Subprime,
Yeah.
America.
Yeah.
right? This is global. Right? No trade, no travel, no
Yes,
nothing.
yes.
Everyone's at home.
Yes.
No income, right?
Yeah.
No, it's
Technically, the world should have ended.
Yeah.
Global financial market should have ended, right?
Yeah.
But no, it did not.
Yeah.
Right? So a bit of that luck.
So luck is actually like he mentioned COVID, right?
Mm-hmm.
So like Asia, it went out at 60 cent or whatever the number was.
Yeah,
Then it went
yeah.
back up to 110.
Yeah.
If you're the guy who's only at 110, you're damn lucky, right?
Yeah,
Because they
yeah.
weren't flying.
Yeah.
How did
flying.
it go? Yeah, how
And
did
the
it
one-
go?
That was for me pure price speculation, man.
They weren't flying, right? And they are worse off
Yeah.
because they have all this debt now because of all the planes and the leases and everything. And all the debt, they have to pay their some of their staff, not all the staff, but they pay some of the staff and the IT costs and so much cost. So their debt has increased tremendously. You can't say they are worth 110.
Yeah.
You can't say they're the same company as this. You should say they should be. If you thought 110 was fair value pre-COVID, which they were at 110, then you say the logical answer should be less than 110, not 110. So the fact that it went back up is luck.
Yeah.
Yeah.
It's just pure gyrations, right?
Yeah.
Okay, I know, it's actually,
Yeah.
almost
I
2
just
hours
realized.
already.
Yeah. I'm like,
I actually have like 4 questions.
you have to pick and choose, man.
You guys are not rushing, I guess, rushing?
5:45 have to leave.
You got it.
Yeah, we
Less
got
than
5
minutes.
minutes. So
Okay,
probably 1
okay,
minute.
okay. So actually, I wanted to ask you about Meta. You alluded to it a little bit, but this
I
time
did,
we will pass the stocks part because we got to speed this up. I think it's only really 2 things, right? And they're kind of linked, I would say. One is, how do you actually think about portfolio management? How do you rebalance? How many stocks you should be holding? How much cash you should be holding? And I'll leave the second question to later on.
In portfolio management, there's no hard rule, but
Yup.
generally our philosophy is you should be hold. If you're an individual investor, you should be holding roughly around 10.
Stocks.
10 anything. It could be whatever. If you want to 10 of any security. So if you want to have 3 bonds, 7 stocks.
I see.
Why is that logic? And there's this study that was done. I can't remember that. I think you know what I'm talking about. But basically, past is a graph on diversification benefits. Past a certain number,
Yes.
it caps out around 20.
Correct.
Okay, then the marginal benefit is like nothing.
Minuscule already,
Then
yeah.
between 10 to 20, there is some benefit, but it's so little. But the thing is, a normal person who has a day job doesn't have time to know 20, because to know 20, you need to have research 100.
Yes.
So if you're just blindly doing 20, it's lousy. You must well do 10. So that our philosophy is 10.
I
Now, if you
see.
really are good, you can do 5 to 10, right? So we try to achieve 5 to 10, but sometimes it's a bit hard. Okay. But 5 to 10 means your portfolio will be more volatile. But if you're on the long term, it doesn't matter. Okay, because if you have 20, 50, 30, you're not knowing all your stocks, you're just
100%.
throwing a dart.
Yeah.
And so we feel the right number is 10 for any security. So some people misuse the word 10, so they go 10 equity, 10 bond, 10, but then you end up 50. So same problem, you can't know everything, right? So we say 10 regardless of security. So when a guy has like 4 houses, then maybe he should only have 6 stocks. 4 houses investment property. You get what I mean? Think of everything. A house is also investment, each house. So if you had 20 houses, can you imagine the headache of dealing with every tenant that has a light bulb problem or water leak? Can you manage? No, you need a team right now. So that should be the same with stocks also. Why is it only in a property when the light bulb, then you go around and then fix his light bulb or fix his leak? So then you need a team, right? So if you have like 20 stock, actually you need a team. You can't handle it yourself. So the right number is around 10, I think.
I see.
But you see, and just to add on that, when people invest in property, the amount of work they do when they buy their property is a lot.
That's true.
They don't buy the one house they visit.
Yeah, exactly.
They go and see the next house.
Yes.
They go and see the next house. They go to the next neighborhood.
Yes.
You got to do that with stocks. You got to do that with stocks. You can't buy Meta just because Meta is a great stock. You got to look
Or
at
Tesla,
what Twitter is doing.
Yeah.
You got to look at what TikTok is doing.
Yes.
You got to look at what Google is doing from an ad perspective.
I love it that you say that, man.
And same thing as Tesla. A lot of people say Tesla, but the reason why we got into the other part of autos is because we studied the rest of the,
correct.
industry.
You have to do the peer comparison.
Correct. So back to 10, you have to limit it because, like I said, when people buy a property, you find a person just says that property I'm going to buy on the spot. No, they go and see the neighboring part. They go upstairs, they go downstairs. They look at 10 units. It takes them 6 to 12 months before they buy one. But with stocks, with stocks they just buy.
True.
It's so true. I love it. My current house, I saw 15 properties before I bought one.
Imagine people did that with the markets.
And then when you're looking, it's not just look, you're like checking here.
No.
So same with stock, it's not
man.
just like read the research report, it's a bit more than that.
It's a lot more than that.
Yeah.
So I mean, that's why our rule when we talk to clients and whoever, it's always that amount, right?
Yeah.
Because work has to go in, right? Otherwise, it's 100% luck.
Yes.
It's like, that's true. 100%.
There's always around a 30% luck to it.
Yes.
Like if we, for example, had kept on Apple for those extra years, then we get that 30% luck.
Yeah.
Even though maybe the number saying maybe you shouldn't keep it. Or any other stock. Let's say he mentioned this other COVID. If you got that, that's luck. We made some returns in 2020 because of luck. Because by right, the country should have been flat that year.
Yeah.
That's good. Now, this last question, I know you guys gotta go. This is maybe more for Donovan because this may be what he enjoys, but Devan chip in as well.
Yeah.
Look, there's so many things happening now in the world, right? I mean, you have inflation, you have congested ports, which is linked to inflation. You have Russia, Ukraine. You have yield curve, yield curves inverting. You have in Malaysia, you have elections coming up. Right? Where do we go from here? I guess, Donovan.
You want the Malaysian answer? The Malaysian answer is only going up, man. Okay, it can only go up, right?
But you're a global fund, so what's the global answer?
The global answer is that people tend to overanalyze things. Ukraine, Russia is a perfect example. Right? Perfect example of the over worry of what would happen.
Yeah.
So that's number one. And a lot of this has to do with media and what generates buzz, right? Inflation is a real thing. Inflation is a real thing. But all of that is based on one or the other, right? So the Ukraine war will affect wheat prices, crop prices, whatnot. Inflation is going to kick in and whatnot. And inflation goes up, central banks has to increase rates because everything is going up. So you need to manage cash flow. You need to manage money supply as well. But eventually, if you look at history, right, and it's very important. I know they say in investments, history is not an indication of future performance. You still have to look at history.
Correct.
Right, and you still have to go back and you look at what and how bankers, central bankers, policymakers have essentially evolved and how they have managed to, I guess, implement whether it's fiscal or stimulus that they need to inject to ensure that the economy globally is just going to manage, right?
Yeah.
So the simple answer to that is the world is going to recover, right? Regardless of how and what, how black people paint what's the future is going to be like, right?
How
It's
bleak
going-
it is.
Yeah, it's going to recover, right? Just from the fact that history has taught us how we would have to be, I guess, proactive in coming up with new ways of doing things. There's no rocket science answer to that, really, because from a global scale, you know, and hence why diversification is so important.
Right.
Yeah.
Right. So sure, you know, inflation is at 8% in America, but it's not 8% in Malaysia. It's not 8% in Australia.
Yes.
It's not 8% in Japan, right? Yes, interest rates and whatnot are going up, but other countries they're still managing it quite well. I mean, if you look at the Middle East, they're managing it quite well as well. So the whole idea of, as a global firm, having that level of diversification allows us to be a bit more free about it,
I understand.
right? Because we know for a fact that, you know, if you're fully invested in Europe, right, then you're in trouble,
Yeah.
right? So you look at all the ETFs that are in Europe, right? All the what's the DAX, right? If you look
Yeah,
at
the
the
DAX,
DAX,
the
and
DAX.
all of that, right? If you're
Yeah.
invested in all, you're going to struggle, right?
Yeah,
and
yeah,
all of
yeah.
that, right? But if you have a very balanced portfolio, right, you're going to feel some pain for sure,
Yeah.
100%.
short term, right? But as Devan said, if you're investing in the long term, all of this little noise shouldn't matter so much.
Yeah.
In fact, you should use this opportunity to then look at what great opportunities you can get out of it,
Precisely.
right?
Yeah.
To buy for the long term.
Yeah.
And just to add to that, actually, a person always likes to ask a question, what's going on with the economy, blah, blah, blah. But actually, you should ask the question based on the portfolio that you have, right? So it could be like if the portfolio you have, let's just say let's just only talk about Russia war, right? If all the portfolio you had, none of them were doing business in Russia, or even if they did, it was less than 1% of their revenue, then you shouldn't even
Does
bother.
it really matter to you?
Doesn't matter. So
Yeah.
sometimes you don't have to worry about every topic and try to be the master economist. That's why sometimes I say economist is not investment. It's because depend on your portfolio. If your portfolio if you're a macro fund, then yes, you must worry more. If you're a portfolio, depend on your portfolio has the diversity in those countries that might be susceptible to war or susceptible to interest rate, interest rate, then you should worry more. Like if you're investing in banking stocks, you should worry more. So things like that. So you should be changing your worry based on what you have.
Yeah.
Not based on what the
It's not a one size fits all. I think that's what you're trying to say.
Yeah.
You need to find what's relevant
To you, yeah.
specifically.
You don't need stress every day.
Yeah, yeah.
Wise words, wise stress.
Yeah,
every day.
yeah.
And look,
Yeah, we have to go.
Just to end, right? I just want to let you know statistically, right? This is the first podcast where 40% of our questions were not asked, and that's just testament to how
that
good the
good or
podcast
bad?
is.
So good? No, it's good. And that
great.
means there's no excuse
For part two.
for part two. Exactly.
Yes, there's so many more questions we want to ask, and guys, thank you so much. I know you guys want to rush off, and let me wrap this up for those who are listening. Again, check them out. Where can people find you actually if you want to be found?
I mean, fine. Like you want to street to stab me or what?
No, like
to reach out to you socially.
emails or any
I am
social
not a
media.
social guy.
We are both not social guys, actually.
Yeah,
Okay.
you just have to go to our website and send us
and,
an email. Send.
Drop us an email. LinkedIn, I guess.
Yeah,
I
LinkedIn.
don't use LinkedIn. I don't use
He doesn't use
Facebook.
LinkedIn.
Wow.
I use LinkedIn.
Okay.
But yeah.
No, I mean I use it to look at things, but not
Yeah.
to interact
Not to
with people.
socialize.
Yeah.
Got it.
understand.
So website MTC Capital. We'll leave a link in the comment section below.
Yeah.
And thank you so much
thank
for
you guys. It's been a pleasure.
Thanks.
coming. Yeah.
No, it was
yeah.
good. Good
All
fun.
right, those
Yeah.
listening, see
Yeah.
you. Peace out.
Okay.
Like,
Thanks.
subscribe, comment. Right?
Subscribe, comment.
Yeah.
FIRL, right?
Viral.
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 We've
Watch
not,
Viral more. We need more of this.
we've not had a guy who has actually came up to us and pronounced it correctly. And it's not their fault. It's entirely our fault, actually.
Yeah,
It's
people
viral.
think-
Yeah, it's
people think it's
viral.
financial
Viral.
independence, retire late,
Yeah,
So,
yeah.
It's like fire, right?
Yeah, but the opposite.
Don't never retire.
Yeah. I'm looking forward to a part 2, to be honest.
yeah.
Yeah.